Okay, I will start the session, which is the mock paper discussion for as the help as the prerequisite for your upcoming examination. Okay, then what's the plan? It's a 3 questions. I think all of you all have this paper with you all. Then what we are going to do? One by one, I'm starting doing in section 1, starting from question 1, then question 2 and the question 3. Likewise, I'm doing. And any questions after completing of the question 1, part 1, then you are free to ask the questions. Secondly, in the question 1, part 2, after completing that, you are free to ask the questions. Like that, let me complete one by one sections. And I will stop and you all can ask the questions and we will complete those questions of yours. And after that, we'll move to the next part. Then this is going to be at least 3 hours, 3.5 hours, maybe more. Then if it is necessary, we will take 5 or 10 minutes in the breaks while we are doing the session. Okay? Not for you all, totally for me. Then that's the plan. Then let me share the screen and we will start. Okay. This is the paper which is July. It's a mock paper for July 2024 your examination. Okay. Then this is a paper, and what I need to highlight in the question 1, it's question 3. It is based on the common pre-scene provided for December 2023 examination. Then when it's needed, when we are doing the question 3, I will take that pre-scene. Then that's for the question 3 in section 2 additional point. Then I'm not going to discuss these things now. When it comes to this one, you know, for your actual paper, time is 3 hours and 15 minutes, definitely. All questions are compulsory, which you have to do. And section 1 and section 2, 2 sections in the paper. In section 1, it is the 25 marks, 2 questions, total into 50. Question 1 main part is non-resident and international taxation. Question 2 main part is the VAT. Other than that, anything with reference to tax planning, advising, decision making, case law, anything can be there. And in the section 2, in question 3, is total for 50 marks based on the pre-scene which we have discussed yesterday. And it's on the pre-scene scenario, the 30 marks for computation, 20 marks for writing. That's the structure of the paper. And you can bring your open book referential materials, which is Inland Revenue Act with the amendments and the VAT Act with the amendments and the relevant gazettes. These are the, which is in the common information which you should know. Then with that understanding, I will start the paper, which is here. The section 1, I'm starting from the question 1. Then here, I'll come to the requirements of the question. It has for the 5 marks, 7 and 3, then altogether 15 marks. Then what's the requirement on the first thing? Lamai, rather than going for detailed answer, we have detailed answers in fully. I will refer to those, but my main focus, I need to analyze the question. Okay, analyze the question and for you all to show what is the answer format or what is the approach to the question. If you know the approach to the question, then of course you all can write the complete or a detailed answer. You all can do that. But if you are struggling with the how to approach to the question, it is an issue. Then while reading the question, my main focus, not just go for detailed answer and discuss, but I need to analyze the each and every points of the question and go for answer format. And after answer format, of course, we can look at the detailed answer, but mainly the time utilization into look at the action verb and understand what it has asked from the students and build up answer format. Then finally, we can go for the move to the detailed answer. Okay. Then here, which is the first one for 5 marks, I will go through all A, B, and C. A, advise whether OFL required to pay income tax in Sri Lanka. That's the first thing. You have to advise whether the OFL required to pay income tax in Sri Lanka. Then when it comes to this discussions, these action verbs are really critical. Then in here, this is a document for you, which is action verbs. Then the examiner has asked one thing and you shall not answer for another thing. Then you need to answer for this action verb when answering a particular question in advice type. Then here it is in the evaluate, the tier 5. In evaluate, what is the meaning of evaluate as a whole, the section? What is the meaning of evaluate? It's the formulation of judgments and decisions about the value of methods, ideas, people or products. Then in that, you have to take your judgment, you have to prove that, you have to give a recommendation. Then under that, the advice, it's given, offer suggestions about the best course of action in a manner suit for the recipient. Then, whatever case, you need to analyze the given scenario, the information, you have to link it to the provisions of the Act. And after that, you should give a conclusion. And your conclusion should be very strong conclusion with the particular, not judgments, based on the particular information. You need to prove that. Then that's what we are going to do for this 5 marks. In here, now it's given how you are going to advise. Then in that, support your answer, see it in statutory provisions of the Inland Revenue Act and its amendments and the relevant articles of double taxation treaty between Sri Lanka and India. Then here, you know, in your papers, the relevant articles of this is for the pre-seen information. Then the relevant articles of double taxation treaty, it has been provided in your paper. Yeah, these are the information. Then it has been provided in your question. Then for you, when doing the question, you can refer to those. Then come to this question. Okay. While supporting the answer from the statutory provisions of the Inland Revenue Act and from the double taxation treaty, I have to tell or I have to advise whether OFL required to pay income tax in Sri Lanka for the 5 marks. And next one for 7 marks, compute income tax liability of OFL in Sri Lanka, including the remittance tax payable for the year of assessment 23-24. Now there is a link between these two. Now you can see these two, there is a link. What's the link? In here it has given, I have to advise whether the OFL has to pay tax in Sri Lanka or not. In part B it asking, you have to compute the income tax liability. Then therefore, this part A is always, it's not always, based on that, it shall be there, the OFL shall liable to pay tax in Sri Lanka. That is your conclusion. If you have, if you don't came for that conclusion, Then here, the part B, it's again struggling. Therefore, at least taking 1 minute, read the requirements of the question, especially in this kind of the scenarios. It's help for you, okay, to build up your, which is in thinking pattern when you're answering. Then we see, explain whether OFL entitled to tax credit in India for any taxes paid in Sri Lanka. We will look at for that 3 months later. Now I will start from part A. Okay. Then here, what it has given, I'll read the question, and while reading the question, the necessary points I need to take in a separately. Then it's the part 1 in that Oral Fresh Limited, OFL, is a company incorporated in India. Now, this is company incorporated in India. If this is incorporated in India, this is resident company, or this is non-resident company. This is non-resident company. That's the first thing. This is non-resident company for Sri Lanka. And in the business of, and is in the business of developing and installing customer relationship management systems, CRMs, in worldwide. That's their principal business activity, which are customized to support businesses to effectively attract and retain customers. Which customized packages. The company has developed and managed a large-scale CRM solutions which widely used by many banks and other companies in India. Now, this is their principal business activity, developing the customer relationship management systems and their expertise on that. Now, that's on the Indian company, which incorporated in India. What's the relationship for us? Then we need to look at that. In the second paragraph, the Keep Safe Bank PLC, KSBP, has been approached to OFL to develop a special loyalty program for its credit card holders to attract more customers to use the KSBP credit cards. Now they are going to develop the customer relationship program through their credit cards, which given to the in the bank, which given to the customers. Then what has happened? It is resident company. The Keep Safe Bank PLC is a resident company. OFL is the non-resident company. Done. Third paragraph, the KSBP entered a contract with OFL in June 2023 to obtain a special customer loyalty solution. This is the relationship. KSBP Bank, it's been a resident company, entered into agreement with the non-resident company. Okay, now this non-resident company, due to this contract, then that company paying tax or liable to pay tax in Sri Lanka or not, we need to look at. Now let me forget out all these information. Then let me come to basic principle. If there is a non-resident company, to that non-resident company to pay tax in Sri Lanka, then what should the first condition to be satisfied? They shall earn income in Sri Lanka. They should earn in the income in Sri Lanka, which is arising not derived from Sri Lanka. There should be income. Where it has mentioned in the section 4, inaccessible income. Done. Then the next thing, for resident companies there in this link, to non-resident company to earn income from Sri Lanka, we have two income sources, business investment in very randomly other income. Then in the business income to earn for non-resident company, there should be what? there should be a permanent establishment. Then what you have to look at, now you know there is a resident company and there is a non-resident company. There is a link between these two. But what is the income earned in non-resident company? What is the income earning from Sri Lanka? That's what you need to capture here. And that income, if it is there is an income, how that income derived? Is it through the permanent establishment or not? Now that's in my mind, I'm clear on that. Then with that understanding, I'm reading the question. Then here, KSPP entered a contract with OFL in January 2023 to obtain a special customer loyalty solution. The technology platform on which the loyalty program will be run is maintained in India. The entire the platform, it is in India. KSBL will access this platform remotely from Sri Lanka through its computer systems. There being a ban, I can approach to that. OFL will be working with merchants in Sri Lanka. Example, now they are promoting on their credit card. Then example, hotels and restaurants, clothing shops, supermarkets, to tie them up with the loyalty program. To facilitate the redeeming the loyalty points at these merchant outlets. Then this is the program to enhance the business. Then here, now still, we don't know what's the structure of this contract. Now I'm coming to perform the project with KSBP. First one, employees of OFL were required to visit Sri Lanka to set up the loyalty program and facilitate the affiliation with merchants. Then 5 employees of OFL were in Sri Lanka during the period June 2023 to September 2023 for what? To set up the loyalty program. Very, very important. They were working from the corporate head office of KSBP. They are physically present in Sri Lanka. The loyalty program was officially launched on 1st October 2023. The contract signed on June 2023, and they have started their work from June, ended in September 2023. That is on the first place. Second, 3 employees visited Sri Lanka for about 8 to 10 days a month from September 2023. The journey has not ends from the September. Even per 2023, what has happened? The employees coming to Sri Lanka. It's up to March 2024 to connect with the merchants in Sri Lanka. That's a perspective. These employees work from the respective merchant's office. At the end of the March 2024, there are 105 merchants on the project. We are successful. Like this in the hotels, clothing shops, which is a restaurant, whatever, it has connected. Done. Now, the third one, it's given the fees for developing. The fees for developing the loyalty program as agreed between OFL and KSBP are as follows. In that setup of the loyalty program in Sri Lanka, US dollars 250,000. It's a USD, currency is USD. And merchant affiliation fee up to 100 merchants, US dollar 15,000. Thereafter, US dollar 100 per merchant. Now we have 105 merchants. From that, a fixed price for up to 100 merchants. It's a US dollar 15,000. And for balance 5, it's per merchant, it's $100. Then manage the loyalty program in Sri Lanka, $50,000 per annum, payable upfront at the beginning of each year. It's an annual fee, but remember, we have signed the contract for this on the June 2023, but it has managed the loyalty program. Then it is the completed, officially launched from 1st October 2023. Yeah, it has officially launched on 1st October 2023. Then this is annual fee. It's based on your judgment, which is it's annum or then it's started launch on 1st October 2023. After launching only, manage the loyalty program can be done. Then it's not from the date of the contract signed. Then therefore, these are the income information it has provided. Now, which is the next one, for the accountant of OFL, identify the following expenses, including head office expenses, incurred in relation to its operations in Sri Lanka during the year ended 31st March 2024. The relevant expenses given, staff salaries based on total number of days spent in Sri Lanka. Then that September to March came, up to September came for all this. And the cost of airfare traveling between two countries totally for the official purpose. Then incurred for the production of income of this project. Then traveling expenses, especially for affiliation with merchants. Anyway, we have to go to, this is a part and parcel of the project cost. Then accommodation and living expenses in Sri Lanka. Then it is, there came due to official activity. Then these are allowable deduction. Then general and administration expenses apportioned by head office in India to Sri Lankan business operations. Very clearly given the head office expenses, general and administration expenses, apportioned by whom? Apportioned by head office. The head office expenses, which in India, the head office, that particular expenses apportioned to the Sri Lanka business operations, it's 13 million, which is the head office is India. From that, the relevant expenses apportioned to Sri Lanka as head office expense. That means that particular expenses which applicable to head office, it has allocated to in Sri Lankan business operation. And what's the maximum limit it can done in head office expenses? What the maximum limit we can incur? It is only 10% from the under section 79. It's 10% from the assessable income. Then we need to look at this 13 million in LKR. This the currency is in LKR. This 13 million, is it compatible? And last one, rent on premises in India, where the servers are maintained in India. It's very clearly given in here, where the point it's the KBBS has the access from that particular database in here. There was that statement. And after that, it's a portion based on the floor area. Then it's the expense which I shall incur to production of income. Then the details of the other details. Then assume $1 equal to LKR 305 and the which is extract of the articles 5, 7 and 23 in the agreement between the government of the Sri Lanka and the India, it has provided. Okay, in the annexure 1 for your reference. Then this is the total question. Now I need to come for the first 5 marks. Very easy, Lama. Now you have read the question fully. Now I need to look at data income, okay. And for this one, for OFL to pay tax in Sri Lanka, then of course, there should be as a company, there should be a business income. To have the business income, there should be a permanent establishment. Now, provisions of the Inland Revenue Act in the permanent establishment, no. Why we cannot apply? The reason is in section 75 subsection 2, it's very clearly given. If there is a double taxation treaty, I have to apply the provisions of the double taxation treaty. Now in here, there is a treaty. What is the treaty? Sri Lanka and India. Then I need to look at what is the provision of the Sri Lanka and India double taxation treaty. It's in your paper, but I'm referring to the treaty because it's easy. The scrolling up and rather than scrolling up and scrolling down. Then here I'm coming to the treaty, which is Sri Lanka and India. In that, what it has given in the Article 7. Article 7 of the Sri Lanka and India Treaty, it's given computation of the business profit. In that, which is, I need to come for second paragraph, subject to the provisions of subparagraph or paragraph 3, where an enterprise of the contracting estate carries on business in other contracting estate through a permanent establishment situated therein, then we need to compute what the profit attributed to the permanent establishment. And we have to consider it as a distinct and separate enterprise. And very clearly in the third paragraph, it has provided, which is how to determine the profit on that permanent establishment which belongs to non-resident person. Then there shall be allowed as deductions expenses which are incurred for the purpose of the permanent establishment. Is it compatible with our section 11 application? The incurred for the production of income, but for sure other than capital nature. And how to compute business income, then that it has given the according to tax laws of that state. Then very easy. What's the difficult thing you need to understand is there is a permanent establishment. Now, in Article 7, business profit, it has given, if there is a PE, the business profit of that PE shall be taxed in Sri Lanka, and how to compute according to provisions of the domestic law. Now, I'm quickly coming to Article 5 of the DTA between Sri Lanka and India for me to check whether there is a so-called permanent establishment. Now come to Article 5, what it has mentioned. In the first one, it has given, for the purpose of this agreement, the term permanent establishment means a fixed place of business. Now the question, in our case, do we have now asked these questions? Okay, do we have a fixed place of business? No. Then the term permanent establishment includes especially place of management, branch, office, factory, workshop, mine and oil or gas well, plantation farm, a sale outlet, warehouse. Do we have anything like that? Nothing. And the paragraph 3A, a building site, a construction, installation or assembly project, or a drilling rig, or supervisory activities in connection therewith constitute a permanent establishment only for such site, project or activity lasts more than 183 days. Then under subparagraph 3A, it's talking about the building site or construction, installation project like that. Do we have something like that being OFL? No. Now come to the furnishing of services, the service PE. The furnishing of services including construction services, consultancy services, by an enterprise through employees or other personnel engaged by the enterprise for such purpose constitute a permanent establishment. Furnishing of services commonly. It includes consultancy services also. Now in our case, I being OFL, am I providing service or not? Yes, I am providing a service. To whom? To company, resident company in Sri Lanka. Then using who I am providing service, then we need to look at that. But only now it's a which is engaged by the enterprise for such purpose, constitute a permanent establishment, but only where activities of that nature continue for the same or connected period within the contracting state for a period or periods aggregate more than 90 days within 12 months period. If it is so, OFL creates a permanent establishment. Which permanent establishment? In a kind of a service PE. Now in our question, am I compatible with 1, 2 or 3, 3A or 3B? 3B. Why? In the question paper, it has given to perform the project with KSBP, employees of OFL were required to visit Sri Lanka to set up loyalty program and facilitate the affiliation with merchants. 5 employees of OFL were in Sri Lanka during the period of June 2023 to September 2023. June, July, August, September. At least for it is 60 and 120 days. It shall be only 90 days within a content period of the 12. It's continuously for a period. It's the wording it has given here for the same or connected project for the 90 days within 12 months period. Then in here, when it comes to this, the 12 months, it's starting from, if it is taken 1st June 2023 and ending with the 31st May 2024, that's the 12 months period. With that 12 months period, more than 90 days, this is staff, the 5 employees stay in Sri Lanka. Not only that, even hereafter, 3 employees, which is about 8 to 10 days of the month after this launching of this, they visited Sri Lanka. Then it's now the question, is it created a PE? Answer is yes. Which in the Article 5 of the Sri Lanka and India Treaty, in subparagraph 3, in para B, it has created PE. If it is created a PE, then as per Article 7, which is a business profit article, what we have to do? We have to compute business income and pay tax with reference to OFL on income arising in derived from Sri Lanka. This entire part you should write for 5 marks. This is the 5 marks in here. We have to quote from the provisions of the Inland Revenue Act and the DTA. Now let me come to the answer. Then here, which is okay. Then it's section 1 in that part 1A. It's a 5 marks. Then you can maximum take 9 minutes. Then as per section 69(4), if a company incorporated outside Sri Lanka, it is a non-resident company. And as per section 4, income arising in or derived from Sri Lanka, that accessible income from business or investment shall liable to pay tax in Sri Lanka. That's the first thing. And since OFL incorporated in India, it is non-resident company, and if OFL earns income from Sri Lanka, then they shall liable to pay tax in Sri Lanka. However, to tax a business income of a non-resident company, there should be what? Permanent establishment. Very easy points. The points by points, you can write your answer then rather than writing for a long paragraph, then a small paragraph, please write, not the points, small paragraph writes, then it's easy for you and it's a clear answer is there. And since there is a DTA between Sri Lanka and India, and accordingly shall evaluate key exposure to identify the tax implication. If there is a DTA as per section 75(2) shall apply the provisions of DTA, don't forget these fundamental points in non-resident and international taxation. And what it has given in Article 7. Article 7, it has mentioned, I have not taken as it is, but converted for the words which is writable. Then Article 7 of the DTA provides that the profit of an enterprise of one contracting estate will only be taxable in other contracting estate where such enterprise carries on a business in that other estate through a permanent establishment in that other estate. If the enterprise creates a PE in such other estate, then the profit of the enterprise attributable to that PE will tax in that other estate. Then now I need to analyze the PE exposure. Then as per Article 5.3b of DTA, the furnishing of services including consultancy services by an enterprise to employees or other personnel, then it's a furnishing of services which is totally relevant for us, and through employees or other personnel engaged by the enterprise for such purpose constitute a permanent establishment, but only where activities of that nature continue for the same or connected project within the contracting estate for a period or periods aggregate more than 90 days within 12 months period. It's considered as a PE. Now, we need to look at the link to this one. What is the link now? In the next, which is red colored paragraph, it has done the provision of the DTA has applied to given scenario. Then for this, based on the information provided, employees of OFL have been in Sri Lanka from June 2023 to September 2023 in full days. That means they are in a corporate office, they have visited in Sri Lanka and they have stayed entire this 4 months in Sri Lanka. Then as such employees of OFL physically presented in Sri Lanka aggregate more than 90 days within 12 months period. Accordingly, OFL will be considered to have a permanent establishment in Sri Lanka and will be liable to pay tax in Sri Lanka. Very simply, if you have quoted from this in the Inland Revenue Act, the Section 4 assessable income from Inland Revenue Act, and the application of the DTA, and going forward, conclude your answer as it's liable to pay tax in Sri Lanka, then this is N for the 5 marks. This is N for the 5 marks. Now, very easy. If you have read the question carefully, you all can understand this. And the next question for the 5 marks one. Compute income tax liability of OFL in Sri Lanka, including remittance tax payable for the year of assessment 23-24. Now it's easy. We have income, the profit before tax has not given. Then we have income and we have expenses. But very carefully, I need to adjust on what? The head office expenses. Now let me quickly come to this one. These are my income. Set up loyalty program, merchant affiliation with these two components, manage the loyalty program. Then when it comes to manage the loyalty program, setup of the loyalty program is 23 June to September 2023. Then the managing is starting from, in our year, from 1st October 2023. Then it's the per annum, we have to divide by the number of months and we need to take. And these are the expenses. Now let me quickly come to the computation. The income tax liability in here. Okay. Then what I first done, based on the information, I need to compute profit before tax. Because there is a head office expense, then I'm not doing everything together. Then I need to complete the up to profit before tax. And after that, I need to come for business income and assessable income and adjust the head office expenses, which is easy. And it is not, which is making me trouble at my exam. Then, which is computation of profit before tax for the financial year ended 31st March 2024. Then income details as it is I have taken. Then which is in setup of the loyalty program, US dollar. Then is 250. Merchant application fee, it's up to 100 merchants. Then it is 15,000 US dollar, it's fixed. Thereafter US dollar 100 per merchant type. Then we had the 105 merchants here. Since it's 105 for first 100, 15,000 US dollar. After that balance 5 per merchant US dollar 100, that into 5. Then here, which is exceeding of 100 merchants, then 5 into 100, the 500 US dollars. Then the managing of loyalty program, it should be divided by 12 and multiple by October, November, December, January, February, March. It's only for the 6 months. Okay, it's only for the 6 months. Then managing of loyalty program, it's with the assumption that loyalty program managing, it's applicable after completing the project. After completing the loyalty program, the management part will arise. And then okay, then it is 25,000 US dollars. Then my total income is this 290,500. And immediately what I am doing, I have converted that to LKR. Why it has converted to LKR? The reason, Lamai, you can read the question very carefully. It's given the expenses in which currency? LKR. Then for you to go for balance part, it should be in LKR. Then immediately what I have done, convert it to LKR. Then using my exchange rate given in the question, it's 305. Now I'm good. I'm coming to this one, and which is the total income is this, and I have converted it to LKR. Then I'm taking expenses. All the expenses, because I'm computing profit before tax. Then all the expenses I need to deduct: staff salary, cost of airfare, traveling, accommodation, head office expenses. Also, because in the head office expenses, first we have to deduct and we need to look at what's the profit. Then after that, we need to do the adjustment for business income and assessable income. Then here, in the head office expenses and the rent expense, which is a portion based on the floor area, and profit before tax. This is the total expenses, and this is my profit before tax. 49,852,500. I have not taken it to thousands. Then here, now let me come to this. OFL computation of income tax liability. That is a requirement. That is a requirement which is the compute income tax liability of OFL in Sri Lanka, including remittance tax payable for particular year of assessment. Then here, this profit before tax I have taken from this. and head office expenses. When computing accounting profit, the head office expense has been deducted fully. Then when coming to business income, can we deduct total head office expense which we deducted in P&L income statement? No, it shall be disallowed first. Then we have to disallow that. Why? In section 79, very clearly given what is the maximum amount of head office expense we can deduct. Then therefore, to go for that adjustment, then I need to disallow this very clearly. And why we are going for that domestic law provision? And the reason is, Lama, in the double taxation treaty, when computing business profit, what the law has provided in the treaty, you have to apply the domestic law provision. This is very, very important, these things, for you to apply correctly at your examination. Then, I'm good, which is the head office expenses disallowed, and this is my business income. Now, for business income, only that we have, then the assessable income before adjusting head office expenses. Now, I need to come for adjustment of the head office expenses. In the adjustment of the head office expense, from this one, which is the assessable income, from my assessable income, 62,852,500, from my assessable income is a maximum which I can take. It's only the 10%. It's only 10% I can take. Now, you may have a question, what is this? Why it has divided by to adjust the head office expense, which is only 10% from the assessable income of this non-resident person. Why it has taken 110 into 100? Lamai, look at this. Look at on your figure. Your figure is assessable income before adjusting head office expense, but it has included the head office expenses. In this, the head office expense, in this assessable income, the head office expense has included. We have disallowed it, and this assessable income is including the head office expense. Then we have to take 10% out of that. When taking the 10%, this 62.8 million included with head office expense. Then I need to take it as 110, and I need to take only the 10% on that to deduct. Then less head office expense, section 79. Then assessable income after adjusting the head office expense is 57,138,636. Now you can see, if you have looked at from this 57 million, straight 10% is this answer. That's how it's taken. The head office expense again, accessible income again 10%. Without head office expense, what is the amount we have to take under section 79? That's what we have done. Then this is accessible income after adjusting head office expenses. Then the qualifying payments, before arriving into taxable income, we have to go for qualifying payments. No qualifying payments in this question. Then the taxable income is same as assessable income. On this taxable income, we are computing tax liability of OFL. Then from this taxable income, I have to apply the tax rate, which is the 30%. Then for this one, the 30% is the 17,141,591. Yeah. Now I need to compute not only tax liability under corporate tax in Sri Lanka, but also it has mentioned the remittance tax payable. The remittance tax payable for the year of assessment 23-24. Then here 23-24. Then here, the next thing, what we need to do, we have to compute the remittance tax. When it comes to computation of remittance tax at the rate of 14%, are you all going to compute the remittance tax for the taxable income? Taxable income against no. What is the definition of the remitted profit in section 62 or 64? Then in the definition of the remitted profit, it has very clearly given, section 62, it's very clearly given that which is the profit to be remitted. It's a profit. Taxable income is what we have computed based on the domestic law provision for us to compute our tax liability in local. And again, the remittance tax, it's always for the profit to be remitted. We are not going to remit the taxable income. We are remitting the profit, then always the profit after tax. After paying the taxes in Sri Lanka. After paying the taxes in Sri Lanka, then I'm computing the remittance tax computation. I have profit before tax. This is my profit before tax. In my income statement, 49,852,500. Then in that, which is the, I have already paid the income tax, 17,141,591. Then profit after tax is this. Even from this profit after tax, for me to compute the remittance tax, which is on this amount, which is 710,909. Then for this one, to compute the remittance tax, always remember, we are remitting the profit after paying the tax. We are remitting the profit after paying the tax. Then therefore, when computing the remittance tax, we need to take what is the profit after paying the tax of the remitted. That means 14% of the remitted tax. After paying that tax, what is the amount we are going to remit? Then in that situation, I need to take my profit after tax, 32,710,909, and it shall be divided by 114. And in the 114, I need to multiply it by 40. Okay? Why is that? May remittance tax එකත් ලංකාවේ ගෙවුවට පස්සේ after paying this remittance tax in Sri Lanka, what is the profit I have to remit? That's what we need to look at. Then here, we need to compute remittance tax on that. Then it's a 4,17,129. This is my remittance tax. And this is my total tax liability, which I have to pay in Sri Lanka. Now come to this. My profit after tax is this. From this one, I have to pay remittance tax this. Then this is the amount which I'm going to remit to India. Now you can see the same answer. It will come, which is when we are making the outward remittance, what is the remittance tax we have to pay? This is on the computation of the tax liability. Remember, there are two components. One is the corporate income tax and other one is the remittance tax, which separate calculation which we have to do. This is the end of the computation. And the next one, which asked for 3 marks, explain whether OFL entitled to a tax credit in India for any taxes paid in Sri Lanka. Yes, Lamai, entitled. The tax credit methods or tax sparing credits available, where it has mentioned, now even in the domestic law provision under Inland Revenue Act, which is section 80 and 81, which is on foreign tax credits are there. It's for the residents in Sri Lanka. But this is not asking on that. This is asking, explain whether OFL entitled to a tax credit in India. Asking on OFL. Then we need to look at the double taxation treaty. In double taxation treaty, it's given Article 5 and 7 we have done. Article 23. Then let me come to Article 23 of the double taxation treaty. Then here, what is the Article 23? Here. Then methods for elimination of double taxation. Methods for elimination of double taxation. Then in India, how to avoid the double taxation in India. In that, which is given, where resident of India derives income which, in accordance with the provisions of this agreement, may be taxed in Sri Lanka, India shall allow as the deduction from the tax on the income of that resident an amount equal to the tax paid in Sri Lanka. What OFL has paid in Sri Lanka, subject to that amount, tax credit will be available. Such deduction shall not be, however, exceed that portion of tax paid as computed before the deduction is given, which is attributable as case may be to the income which may tax in Sri Lanka. Its maximum, what is the income earned from Sri Lanka, in that what it has included, then for that one, as per the Indian law, what is the tax liability, then it shall not exceed at that amount. Up to that liability, which a foreign source, what is the amount taxable in India, what is the tax liability, up to that tax liability, we can claim the which tax credit, okay? Then this is for 3 marks, looking at the methods of elimination of double taxation, which I need to tell, not only that main articles like dividend, interest, business profit, permanent establishment, royalty, which is in that key things, but even the protocol, even these methods of elimination of double taxation and the which this article, which is a non-discrimination article, these are can be test your examination. Okay, whatever the good news is, whatever it is testing, then it shall be given in your question paper. Then you have to look at that, read it, and you have to apply. Okay, then that is on the all 15 marks for the here, all 15 marks for this non-resident and international taxation question. Now I will stop from here and I need to go for the questions. If any question if you all have, I need to go that, and after that I will come for the balance 10 marks of the part 2. Let me check any questions. Yes. Can you explain the remittance tax calculation part? Okay, I will explain. For this one, always the first thing, remittance tax will be payable on the profit. It's not the on taxable income. The taxable income is in the domestic law provisions what we have computed. But we are paying remittance tax on the profit which we are remitting to India. Then always, what is the bottom line in my income statement? It is my profit after tax. Then always we are remitting the profit after tax. On that profit after tax, if we have applied directly 14%, it's incorrect. From that profit after tax, after paying the 14% of the remittance tax, only we can remit to India. A profit after tax එකනොත් 114ක් ලංකාවේ ගෙවුවට පස්සේ ඉතුරු වෙන profit එක තමයි මට remit කරන්න පුළුවන්. Okay, then we have to compute that the backward calculation we have to compute. Then this profit after tax, it has included with my remittance tax. Therefore, this remittance tax, the profit included in remittance tax, is a we need to take fraction the 114 and multiply by 14. If it is equal to 114, what should be the 14? Then that's how it's taken. After deducting remittance tax, now the same calculation I will do. This is my profit after tax. Then profit after tax, if I have taken the directly 14%, it's incorrect. Okay, this is incorrect. Then what I have to do, then I need to take from the profit after tax, the profit after tax included with the remittance tax. Then I need to take what is the value of the remittance tax. Now I'm deducting the remittance tax here to this different calculation for you to show the logic. Then here I have profit after tax. From that, the remittance tax 14% it has deducted. For me to remit to India, now I have a profit after paying all the taxes in Sri Lanka. Now I have a profit 28,693. Make a remit remittance tax. Then here for this one, by applying 14%, you can see it is 4,017,129. It's the same application. It's the same amount it will come. Now this is on the remittance tax application. And that was for, will you share the answer sheet with us? Unable to jot down as fast as you do. The thing is, okay, I will share. If it is so, okay, let me give, after complete this question one, then I will stop share and I will email this, sure. For remittance, should we consider taxable income or profit before tax? That's why it has mentioned it's not the taxable income. Lamai api taxable income එක remit karanne නැත. We are not remitting the taxable income. Why we are remitting taxable income? What's the requirement to remit the taxable income? Then it's a domestic law to pay tax what we are computing. We are not, is it actual figure which we have? No. We are remitting the profit. Lama, please go through the remitted profit definition in the act. Then it's a remitted profit. We are remitting what the remainder for us to remit to the head office. Then therefore, don't forget it's a profit. And it's not taxable income. The taxable income, which is to pay the corporate tax, we are computing is a taxable income. The patrically that's mean the tax is a patrical subject. So then for what you are learning in Patris, there is no change. Then same thing we are doing in Patris with reference to non-resident companies, no change. And even when we are remitting the money, for the outward remittances, we have to fill the documents application. In that, the same calculation on outward remittance, who is going to bear the tax burden based on that, these calculations are there. Then please remember, we are not remitting the taxable income. It's a notional figure which we are computing according to the domestic law provision for us to pay income tax in Sri Lanka. And we are remitting the profit, what we have earned in Sri Lanka. Okay. Then I think I have answered all the questions. Okay. Then what your suggestion is, we need to share these answers. Yes, I will do that. What can I do? Please let me go for the balance 10 marks also and complete the question 1. If not, we are running out of time. And after that, I will give 5 minutes to y'all. And after that, I will email the answers. and they will share with you. And come to the balance part of the paper, which is the part 2. In part 2, which is the question on individual taxation. Not only the individual taxation, it's but also with capital gain and the individual tax and different realization provisions. Now come to this, which is the question 2, Roman 1 for 2 marks, 2 for 3 marks, and 3 for 5 marks. First one, explain the tax implication of Miss Nikita on properties transferred to her by death of Mr. Asela Bandara as per the provisions of the Inland Revenue Act. And the second one, assess the gain from realization of land and state the due dates of the payment and return filing for capital gain tax by Miss Nikita. And third one, assess the balance tax payable by Miss Nikita for the year of assessment 23-24. These are the 3 requirements. Then anyway, for approach to these 3 requirements, then we need to go for the information given in the question. I will come to the information. Mr. Asela Bandara was a senior advocate in Sri Lanka, and he is the owner of the many properties, including bare plots of lands, plantations, which he was purchased from his earnings, as well as inherited properties by parents. He has 2 sons and daughter named Nirmal, Nishadya, and Nikita. Miss Nikita graduated from the University of Colombo with a degree of Bachelor of Laws and initially started her career at the legal department of Solid Access Private Limited from January 2023. Okay, it's not the January 2023, it's not the part of our year of assessment. At the monthly salary of rupees 100,000 and it increased to rupees 175,000 from 1st July 2023. Okay, now you have to read these points very carefully. I'm also reading with very carefully. Then it's a monthly salary. Then it is the rupees 100,000 per month. And it's increased to 175,000 from 1st July 2023. Then APIT deducted on salary is 58,500. This is for entire period. Now you know for 100,000 the APIT shall not applicable. It's a if the 101, then from that point APIT is applicable. Then you can see her salary details. It has changed. Within the year of assessment 23-24, then which is that April, May, June, there is a 1 salary scale, and from July to March, there is a 1 salary scale. Then April, May, June, 3 months, and the balance 9 months, there are different salaries. Then why I am highlighting these points, we have to assess the balance income tax payable by Miss Nikita for the year of assessment 23-24. Okay, and here okay, then that's the reason which I'm looking for these each and every points. And the next, which is 3rd paragraph, however, things are not always doing well. Due to the vehicle accident in mid of the May 2023, okay, Mr. Asela Bandara has passed away, which is after 3 years from the death of his wife. As per his last will, property is divided to the family members. The 3 family members' properties were divided. Miss Nikita received 2 stories of building, a bare plot of land, and plantation as per last will. The building was constructed in 2018 at the cost of rupees 8 million, and the land was purchased by Mr. Bandara in 2008 at the consideration of 13.5 million. Consideration of 13.5 million. Okay. Then the building has been given for rent to a company from 1st October 2023. Now again, this building after the death was transferred to her, Miss Nikita, then it has given for rent to the company. Now when reading these things, you should have to remember application of what? Application of withholding taxes. Then rent to a company from 1st October 2023 onwards. Now in the middle way of the year of assessment, property has given for rent at a monthly rent of rupees 250,000. Now my monthly rent is exceeding rupees 100,000 or not exceeding. And property has given for what? Property has given to a company. Then it's for the business purpose, to conduct a business. Then if the rent is more than 100,000 per calendar month, if the property has given for rent, then the 10% of the WHT is applicable or not applicable. Then the company, this company, properly deducted the relevant WHT and remitted to IRD. That is on the rent income, the particular details. However, she has decided to sell the bare land. What is that? Then it's a bare plot of land she has received. Now she has decided to sell this bare plot of land. Why? Since it is situated too far from Colombo and the transaction succeeded on 20th February 2024. She sold the property on 20th February 2024. What is the consideration? At a consideration of rupees 17.5 million. The assessed value of the land is rupees 17 million. Why this assessed value? When we are taking the consideration, we need to take what? Under section 38 of the Act, we need to take the actual selling price and the assessed value, whichever is higher. What is the assessed value? Assessed value is the value of the asset immediately prior to the selling or at the date of the sale. What is the value, market value of that particular asset? Then they have ascertained that it is 17 million. Then even the value for stamp duty, we can take it as the assessed value. She has incurred the 3% of brokerage fee as fees on consideration. Now my consideration from this to the highest one is 17.5 million. Out of that, I have incurred the brokerage fee of 3% of that. Advertising cost 150,000 upon the sale. The valuation of the land as at 30th September 2017 is 15 million. Now all the details given to compute my second requirement. What is that? Assess the gain from realization of land. That's one requirement. Not only that, we have another requirement asking state the due dates of the payment and the return filing for capital gain tax by Ms. Nikita. These are the two requirements asked. Then for that, this information more than enough. Now let me come to balance part. Ms. Nikita received net interest income from fixed deposit matured in 15 November 2023 within our year of assessment. Then net interest income, it's amounting to rupees 350,000. And gain from disposal of listed shares, 106,000. Then I know you all know these things. This is exempted from income tax, which is the categorized under investment income. Then last paragraph, the gross dividend income as per the dividend warrants, rupees 96,000, and out of that 16,000 received from dividend distributed out of dividend received. For this one, this 96,000, in that 80,000 distributed out of profit and 16,000 distributed out of dividend income received for that particular resident companies. 16,000 is exempted, balance 80,000 is final withholding payment. Now, all the information we have read. Now again, I need to come for requirement. First, explain the tax implication of Ms. Nikita on properties transferred to her by death of Mr. Asela Bandara as per the provisions of the Inland Revenue Act number 24 of 2017 for 2 marks lamai. She, Ms. Nikita, does not have any tax implication. Why? There is a special realization provision. In the special realization provision here, which is the explanation non-tax implication on properties transferred after the death of father. Under section 45, which is special realization provision, no tax implication to Ms. Nikita. But as per section 45, transfer of assets on death, where an individual realizes an asset on death by way of transfer of ownership of the asset to another person. This, in our scenario, father's properties transferred to Ms. Nikita. Then it considered as transfer at what price? Transfer at the net cost of the asset. Transfer at the net cost of the asset. And the person who receives the assets received at the net cost of the asset. Then what's happened? At the point of the death, the properties of deceased person transferred to the other party at net cost, and other parties assume that it's a deeming provision, other party acquiring that assets at net cost. Then how to compute the gain? We are computing gain is the consideration minus cost of the asset. The consideration minus the cost of the asset. Then under that situation, my consideration equal to net cost. Cost also net cost. Then the gain is 0. Therefore, no gain can be recognized it considered as Miss Nikita acquired assets at the net cost. In the question, it has given building 8 million and land 13 million. Then therefore, the father no more there. Then the consideration is, if I have right in here, consideration equal to net cost. And the cost also equal to net cost. Then thereby consideration minus cost is the same amount. Therefore, it is gain is 0. From the hands of Miss Nikita, no impact. But Lamai, there is a critical point you have to take, which is Miss Nikita acquired the ownership of the assets coming to Miss Nikita at the net cost. At the net cost as per section 45. That is for 2 marks it has provided. And the easiest calculation, which is a computation of gain from realization of investment asset, which is a land, then consideration given, which is the selling price 17.5, assessed value 17 million, whichever is higher I need to take. Then its actual selling price 17.5. Then net cost of the land at the time of ownership transferred from father, we need to take as the cost of the asset. Now the question, coming to the question. In the question, it has given 30th September 2017 valuation. Can we go for this 30th September 2017 valuation? Now, my father has acquired the property on 2008. Is that the year the daughter has acquired the property? No. It has acquired by her on 2023. And it's acquired at a net cost. Then therefore, at the time of death, that is the important point. When we are, it's not that the first 2 marks. If you have not got the first 2 marks correctly, then your balance, how many marks? The balance 3 marks, it's maybe not successful. Then here, which is the transferring, I have received it at net cost, which I have incurred the cost equal to net cost. It's a 13.5 million. Then net cost of the land at the time of ownership transferred from father, 13.5. Then incidental expenses, we had brokerage fee from the selling price, 3%, and advertising cost, 150,000, and nothing other than that. This is my total cost, and gain from realization of land is this. I being individual, Miss Nikita, I'm individual, and the capital gain tax at the rate of 10%, it is applicable. Now in the question, it has asked the assess the gain from realization of land and state the due dates of the payment and return filing of the return filing for capital gain tax. Then I have computed the tax also here. Then for this one, and put a note, valuation as at 30th September 2017, not relevant. Due date of the submission of return. What is the due date of the submission of the return in capital gain? It is the within 30 days from the end of the calendar month in which the transaction happened. What is the due date of the payment? In section 83, very clearly given, the due date of the payment shall be equal to due date of the return filing. Return filing is in section 93. The payment is in section 82. Then combinedly, the answer should be there. And here, okay, as per section 93 of the Inland Revenue Act, every person with taxable income consisting of a gain from realization of an investment asset shall file with the Commissioner General a capital gain tax return. What's the period? It is within 30 days after end of the relevant calendar month in which the realization occurred. You have to match with the 30 days. Just don't count the 30 days. 30 days from the end of the calendar month which the transaction happened. Within 30 days after the end of the relevant calendar month in which the realization occurred. Then payment of capital gain tax as per section 82(2)(c). The capital gain tax payable by a person on the disposal of an investment asset should be due on the date of the filing of the capital gain tax return. Then it's the same. Therefore, the payment due date and the return submission due date is same. Now, the question. For us to tell what is the date, we need to look at what? In which date this has disposed. How the disposed කළා කියලා තියෙන්නේ transaction succeeded on 20th February 2024. Then since it has succeeded on 20th February 2024, this is the date of disposal. Then it's 20th February 2024 done. End of the, what is the end of the calendar month which the transaction has taken place? It is in 2024, it's a 29 February 2024. Then, ඒක ඉවර වෙලා within 30 days or no before 30th March 2024. Then this is the answer for sub-requirement of the question, which is on no before 30th March 2024. Okay, this is on capital gain tax and this is on the tax implication on transfer of asset at the time of death. And the last part for 5 marks, which it has asked on the assess the balance tax payable of Ms. Nikita for year of assessment 23-24, individual tax computation for 5 marks. Then very quickly you can do that. The details given, employment income given, investment income given. We don't have business income here. Investment income, don't forget to take this gain from realization of the land. And let me come to that quickly, which is here. In individual tax computation, the Miss Nikita, it's a year of assessment 23-24, income tax computation. Employment income, it's 100,000, 1, 2, 3, 4, 5. 100,000 into 3 and 175,000 into 9. Why? The 100,000 from the up to 30th June 2023, it's 100,000. So from 1st July, the July months onward, 175,000. Then is April, May, June, 3 into 100,000 and rest of the 9 months into 175,000. And this is the investment income. There are different investment income which I need to take. But before that, in employment income, we have APIT. Then APIT on employment income is given in the question 58,500. Somewhere here, it's a 58,500 has been provided. It's my tax credit, tax deducted from my employment income. Done. And it's on employment income and on balance, I need to come for, we have computed gain from realization of land. I have the answer, then I'm taking into my tax computation, which is the gain from realization of, gain from realization of land, then it is 3,325,000. Then gain from the realization of land, it is there. I have not taken this into 1,000. It has taken in rupees. Then here, gain from disposal of land, which is investment asset. I have done the calculation and I have taken it. And the rent income details given. Rent income, monthly rent 250,000. Rent started from the October month, then October, November, December, January, February, March. Completely for 6 months, the rent income is applicable. That is, we have taken. Now, don't forget the rent income of the resident individual. That person is subject to what? 25% of the repair allowance. The 25% of the repair allowance is from the 1.5 million, 25% as a relief you have to pay. And it's on the rent, and the next income source, which is the interest income, the net interest amount given and the dividend given, and the gain from disposal of listed shares given. Here, gain from disposal of listed shares, it is exempted under third schedule, paragraph H, for any person who dispose, in para H, any person who dispose the listed shares, then it is exempted from income tax. It is exempted from income tax. Then for Ms. Nikita also it is exempted. The dividend income I have discussed, which is the exempt dividend, dividend distributed out of dividend income and balance subject to final withholding payment, which is at the rate of the 15%. And yeah, these are the details of the investment income and the interest income. Then in here, interest income from fixed deposit, the net amount given as 350,000. Net interest income, which upon the maturity I have received, is 350,000. Then here, 350 is net. We shall not tax the net interest. We have to gross up it. Then this is equal to 95 and it should be multiplied by 100. Then this is interest income, the gross interest income from FD, 386,421. Lamai, don't forget, you have to do two things. One is to take this 5% withholding tax on the gross interest income from fixed deposit. Second one, taking off 10% of the withholding tax on the rented property which it has given to conduct a business. This is my total investment income. And then coming to tax credits, in that 10% of the rent and the here and on 5% of the interest income. Before forgetting me, I have taken. Now let me finalize the answer. Employment income is there, investment income is there. This is my total assessable income. From this total assessable income, the tax-free allowance is 1.2 million. There is 25% of the repair allowance, and this is my total relief. Don't forget to take the personal allowance. This is not given in a whatever the question. This is not separately given. This is personal allowance. You have to think and apply it. It's applicable to resident and citizen individuals, and the citizens, non-residents, this is applicable. Then 25% repair allowance, you are good on that. We don't have any qualifying payments to Miss Nikita. This is my taxable income. Now come to here. When it comes to taxable income, can you apply this all 5,493,421? Can you apply the progressive tax rates? No, you cannot apply. Why? There is a flat rated amount which we need to tax. What is that? Which is my gain from realization of investment asset. What is the amount? 3,325,000 here. Then therefore, first I need to take this regressive tax rate and apply the, which is tax liability on that. Here we go. This is the tax liability from the 3,325,000 325,000, 10%, 332,500. Not only this one, but also I need to take this as a tax credit. Why? The capital gain, it is a due date, it's a 30th March 2024. Already, Miss Nikita has paid the capital gain tax, which is here. According to this analysis, we can see the payment is due when it has paid. Then, with the assumption that she has made the payment, then capital gain tax, that credit I need to take. Done. Then that is on tax credits, and this is on application of the capital gain tax. And on balance taxable income. What is my balance taxable income? Making him my taxable income 5,493,000. From this, I need to deduct gain from disposal of investment asset. Now, further for me to tax, it's only 2,168,000. Then for this 2,168,000, 421, first 500,000 at 6%, then up to 2 million, I'm going, which is 30, 60, 90, and 120, 2 million, and there is a balance of 168,421. Then it is that at the rate of the 30%, then this is my total tax liability. On this total tax liability, these are my tax credits. From these tax credits, after deducting all the balance tax payable, which my requirement, the balance tax payable for the 5 marks, then it is there, which is the on or before 30th September 2024, you have to make the final income tax payment within 6 months from the end of the year of assessment. Then after that, this is my balance tax payable. Then this is the entire question discussion for the 5 marks of individual taxation with different types of the realization provisions. Okay. Now with this, the entire question for question 1 for 25 marks, it has completed. Now let me come to your questions. Remittance tax QR. Ma'am, can you explain how we got 69.42 through the PE? No, Buddha, the 69.4 we are not going to take to prove the PE. 69.4 to take to prove that resident or non-resident. The section 69 is for the determining of the residential status. Which is section is the residential status. Then residential status for our syllabus, we are looking for section 69.1 and section 69.4. The section 69.1 is for individuals. Okay. Section 69.4 is for the company. Then for company, if incorporated outside Sri Lanka, if the company management and control is outside Sri Lanka, and again the registered office or which is principal office, if it is situated outside Sri Lanka, then those are non-resident. That is the first parameter which we have to take to determine whether this company resident or non-resident. Then that's the first step. That's why in the first paragraph of the question, then it has given that which is Oral Fresh Limited company incorporated in India. Then very clearly, since it is incorporated in India, it is non-resident. Then it being a non-resident, then after that your next steps are coming. Since non-resident, it is not, the world income will not be taxed in Sri Lanka. If it is so, what should be taxed? the income arising in or derived from Sri Lanka under the application of the section 4. Then after that, when looking at the what are the income arising in Sri Lanka being a company, to evaluate whether there is a business income, only we need to go for PE. The section 69.4 is to determine resident or non-resident, not to look at on the permanent establishment exposure. I think it's clear. And if the final answer is incorrect, need to know the examiner provides marks to for other adjustments. Then put a y'all in strategic level. Then which my belief is the process. The students are not going to penalize for the same error for twice. If your process is correct, definitely the marks will be awarded. It's my thinking pattern. Then I think it's the way normally. Then rather than final answer, if your answer process is correct, marks will be provided. And anything, let me take this here, then it's easy for me. Question 1, part 1. Are there any WST on rent? Question 1, part 1. Question 1, part 1 is this. Make a WST එකක් කොහෙද දරුවෝ? WST. What are the adjustments? No, in the question 1, part 1, there is no WST application. There is no rent. It's a loyalty income. From the income from loyalty program, these expenses are there. You are asking in here, which is rent on premises in India, where the servers are maintained, which is apportion based on floor area. It's when this is the expense we are deriving through the permanent establishment. Then the rent expense, then it is for the payment of the head office. Then again for this one, when remitting the money, the WST implication is there, but this is given the accountant of OFL identified following expenses. Then on these expenses, whether remitted or not, it has not given. Then if you have asked on this one, at the point of remitting the rent, there is a 14% of withholding tax implication. Then this is on expense side, and if it is so, it's separately shall be asked. And for this one, which is, it's an expense which it has recorded, it's a payable or paid, the details not given. If it is given like that, then if it is the withholding tax implication is there, it should be provided at the point of remitted this rent, the 14% has deducted, or else this has remitted. Then that is on your next question. Wait. Then no sound and video. Sound is there, video also there. Is that all? Is that happen? I don't think everything is good. I have minimized this, which is on the screen for me to, if not, if they are in always in the screen is here and is showing me again, then now I think you all can see me. Then anyway, I will take this. Then wait. WST online, no sound and video. ඒක පැහැදිලි කරලා කිව්වා මට එහෙම ප්‍රශ්නයක් නැහැ. But as per section 203(4) of that net cost is equal to market value of 30th September 2017. But even at the time of transfer from father, the net cost will be equal to market value as 30th September 2017 as per section 203. Yes, we can. Then in the net cost, this concept, let me come to here. Okay, your question is in answer writing part which is on the net cost of the land at the time of the ownership transfer. Then it is on why don't we take the 30th September 2000? Yes, we can. In here again, the cost is 2000. Yeah, there is a valid point. Then here the cost is equal to net cost in the under section 49 because the father has acquired the property on 2008 and in 2017 there is a valuation given. Then that valuation which is in the question, the amount is, yeah, there is a point. Then 15 million, then we can take the 15 million. Okay, in the asset net cost, in the net cost of the land at the time of the ownership transfer from the father, then this 15 million we can take, and compatible with this one, let me take for building 8 million and land 13.5 million. However, the 30th September 2017 valuation has provided, therefore it equals to rupees 15 million. Okay. Okay. Then it is for the net cost of the land, which is in 30th September 2017 valuation at the point of transfer. At the point of transfer, then it is the 30th September 2017 valuation, and again at the point of selling, it's 30th September 2017 valuation take as the net cost. Okay, thank you for the point. And questions which okay, then we can hear you, ma'am. Thank you. Then could you please explain the application of section 46.1, 46.2, which is on the transfer of the assets in between associated person or for no consideration? And this is not relevant for mock session. Appreciate it. Yeah, sure. I will take the act and I will explain. Then, so when the assets sold, the cost will be considered as 15 million. Yes, it has corrected. Then, any question which I have missed? I missed that part. Can you again explain why did not? Okay, it was now explained. Please explain dividend again. Dividend in individual taxation. What has happened to dividends? In here, the gross dividend income as per dividend warrants, it's rupees 96,000. Then what I have received as dividend based on dividend warrants. Dividend warrant pala tiyenawa, gross dividend income 96. Then in the dividend warrant, it's a one part out of that, rupees 16 million received from dividend distributed out of dividend received. Then the dividend distributed out of dividend received, then it is what? It is under third schedule, it is exempted. Then total dividend which I have received 96,000. From that I need to remove 16,000. Then the 16,000 is exempted dividend and balance 80,000, which already the WHT 15% has been deducted. Then that's why in different manner in here, the individual income tax which we have taken, dividend income, the exempt dividend, dividend distributed out of dividend income received, and the liable dividend, which is it's a final withholding payment. That's why the exempted or final withholding payment. Okay, this is on dividend exemption and final withholding payment. That dividend exemption is applicable for each and every person. No? Okay. Dividend explained, Kala. Ma'am, could you please share the Excel workings and model answers, if any, to email address? Okay. Then, anyway, I will give these answers according to this discussion. What is the final answer? I will provide. Don't worry on that. Oh my goodness, this question, it's good that you have asked regarding due date for capital gain tax return filing. According to the original IRA 93.3, it's mentioned not later than 1 month after that realization. Madam mentioned that due date is 1 month after end of the, not 1 month, it's 30 days. 30 days from the end of the calendar month. In that phrase mentioning which subsequent amendment it was amended through the, if not mistaken, amended Act number 10 of 2021 or the 45 of 2022. 45 එකෙන් හරි 10 එකෙන් හරි දෙකෙන් එකකින් ඔක change උනේ. Then let me check. Don't take the original one. Then here which 93. Let me just check. This is a consolidated act. Then in here, section 93. Which you can see it has changed from the act number 10 of 2021. 10 of 2020. This is a change happened. This is a change to that one. Then it has explained and what is 25% of repair? In individual computation under relief, it is a relief. Relief on rent income, whether it's the repair allowance as the 25% relief, it's coming under 5th schedule covering with the section 52. Please go through these areas. For resident individuals, we have 3 reliefs. One is the tax-free allowance of 1.2 million. Second one is, which is this 25% of the repair allowance. Whether repair has done or not, we are eligible for that. And the third one, which is on the solar relief, a maximum up to 600,000 per annum on the, which is on fixing of solar and connected to the national grid. And it is by way of the bank loan or by way of the cash in hand. If I have utilized, then we can go maximum up to 600,000. Then even below we can go, but maximum is 600,000. That is on 25% of repair allowance. Yeah, I think all the answers given. Then Let me take 5 minutes. It's 8:29. Give me 5 minutes, and I will start sharply at 8:35. And while that, Lamai, the thing is, shall we share the answers after our discussion? Because the some points I need to write and change, then it's better if I can share this answer after the discussion, then please bear with me. I think it's more successful way. Now, even like that, in 30th September 2017, the points which I have missed, then you all mentioned. Then therefore, I think it's good, which is for us to wait until the session and I will share the answer. Okay. Then give me the 5 minutes. I will back. Okay, I will start again, which is the balance part. Up to now, the questions cleared. You all can ask anything more. And that explanation on section 46.1 and 46.2 I will do at the end of the session. I will do. Then, which is in the question 2. Let me come to this value added tax question and the part 2 of this. I will give the answer format, not going for the detailed answer, because these are the answer points and analysis part I need to go. But for this 15 marks on value added tax. Then for this, which 15 marks I will start, which is the assess the balance VAT payable for the quarter ended 31st March 2024 as per the provisions of VAT Act. Then assess the balance tax payable for the quarter ended. Now we have in the VAT, we have 2 taxable periods to compute and return submission, which is the 1 month and the period of 3 months. Then this is asked for the period of 3 months for 15 marks. Okay, then I will come to the details provided in here. In part 1, Tip Top Productions Private Limited, TPPL. I'm using the word TPPL. In the business of handling of event management activities on local and foreign clients since 2016. Okay, what is their principal business activity? Handling of event management activities of local and foreign clients. Then TPPL registered for VAT in 2018. Okay, most of the local are VAT registered and they provide services to persons who are not registered for VAT inclusive prices. Now, there are local clients and there are foreign clients also. For local clients, most of them are registered for VAT. There are persons who are not registered for VAT. We are doing selling. And the following information was extracted from the draft financial statements of TPPL for the quarter ended 31st March 2024. Then, other than specifically mentioned, under all other cases, revenue is exclusive of VAT. That means the revenue is without VAT. If it is not specifically mentioned, then all the things, it's a revenue without VAT. Now come to here, the revenue in event management income from first one, corporate customers. Then it is for exclusive of VAT. Corporate customers at VAT inclusive price, very clearly given. Now you have to do the VAT computation for quarter ended 31st March 2024. Then the applicable VAT rate from 1st January, it is 18%, which you have to apply 18%, not the 15%. But from April to 31st December, on that 9 months period, even for a taxable period of 1 month or even for taxable period of 3 months, the rate is 15%. Then here, individual customers at VAT inclusive price, again, the both same application, which is under VAT inclusive price, you need to divide by VAT fraction. Now, next one, event management income received from foreign customers. It's rupees 6 million. And next one is the commission income, 2.5 million. Then, under other income, we need to look at this foreign customers. Normally it's a zero rated. And we need to look at what is commission income, liable or not, the details we need to look at. And in other income, which is the profit on sale of audio visual equipment, in the event management, then audio visual equipment, rupees 3 million, Lama, it's profit. It's profit. Huh? Then it's been a profit. It's not, it's not valuable. We need to look at the consideration. Why we are looking at consideration? The reason, which is on the under section 83, which is on taxable activity definition, anything related to trade, business, profession or vocation is part and parcel of the VAT. Then it is a supply, it's not the profit. And we have to take the consideration. And the interest income, it is not liable under normal VAT. This is coming under VAT on financial services. Please go through VAT on financial services also. And even yesterday I have mentioned it has not tested from the considerable period. Therefore, it's better to look and go. Anyway, the 100% syllabus you have to go through. But in here, you need to take the particularly in little bit more, please look at and go. It may become, may not, but it's better. And additional information given, TPPL sold audio visual equipment during the month of March 2024 for rupees 5.3 million and issued a tax inclusive invoice to the buyer. Then tax inclusive invoice has issued to buyer on this one. Then what is the consideration? It's 5.3. Then again, we need to use the VAT fraction on this. Second one, during the quarter, the company has successfully completed 2 event projects in Maldives and Singapore. The income from Maldives project received in foreign currency to foreign currency bank account of the company in May 2024. Now come to this. There is a event management income which received from foreign customers. Then from that, the 2 projects are there. One is Maldives and other one Singapore. The income from Maldives project received in foreign currency. Bank account of the company in May. Now it has, within the quarter it has done. Then even if it is so, January, February, March, the income has received in May, April, May. Then that's mean immediately within 6 months from the end of the taxable period in which that invoice relates, we have received the income. Then this is very clearly one thing, the zero rated supply, and very important for us, which is we can claim the input VAT absorbed to this supply. Then that is on the Maldives project. And for Singapore project, amounting to rupees 2,250,000 received from the subsidiary company in Sri Lanka. Now this Singapore project, what has happened in the Singapore project, which is, it's a 2,250,000 from this one, 2,250,000 we need to remove. Then the balance it's from the Maldives and the other part is this received from the subsidiary company in Sri Lanka. If it is received from a subsidiary company in Sri Lanka, is this received in foreign currency or LKR? LKR. This is received in LKR. Now come to this. Services rendered to person outside Sri Lanka and utilized outside Sri Lanka and payment received in LKR, is it zero rated or liable or exempted? It is exempted from value added tax. Then therefore, for this one, it has received in foreign currency to our bank account within 6 months. This is zero rated and the input VAT we can claim. But for this one, it is exempted. Then for this, event management income received from foreign customer, you have to read this and you have to divide this into 2 components and apply it accordingly. Okay. Now let me come to next one. The third point, I will come to answer later. First, I need to go for 1 by 1 points, which is third one. TPPL conducted a negotiation and connection of the service provider and client in Malaysia and India with reference to international event. But they have done negotiated and connected 2 parties, which is India and Malaysia with reference to international event. Company received the commission income of rupees 2.5 million under this transaction. What is the perception of you in this transaction? Which is, there is an Indian company, there is a Malaysian company. Then what I have done, I have connected that 2 companies. That's only which I have done. I have connected that 2 companies, which is the outside Sri Lanka. Entire business has done outside Sri Lanka. Then I have connected them. That's all. I'm a person registered for that. And I have connected this Malaysian company and the Indian company. Then under this situation, I have received commission income. Then for this, if anything, I have done, which is in Sri Lanka, for me to pay VAT in Sri Lanka. That's the question. This like which in the providing of service to 2 companies on their international event. Event is conducted outside Sri Lanka. 2 companies are in outside Sri Lanka. I have just contact that 2 persons. Then is nothing which is bring into Sri Lanka. Nothing conducted in Sri Lanka. Everything is conducted outside Sri Lanka. It's international event. Then this is like offshore. This is something. Then what is the tax implication on this one? This kind of activities, is it covered under charging section of the value added tax? What is the charging section of the value added tax? It is given which is taxable activity shall be conducted where? Conducted in Sri Lanka. Did something happen in Sri Lanka? No. Then this is what out of scope of the charging section. Excluded supply very clearly. Then this commission income, we shall not tax in, we shall not charge the value added tax on this. The different perspective, then it's a different approaches. That is on third one. And fourth one, VAT paid on import of event equipment. It's a VAT paid, upfront VAT paid on importation of event equipment, rupees 950,000. Then for this one, which is the amount is VAT paid, don't apply 18% on this. VAT amount has given event equipment directly connected to my business. This all the activity, all the business activity, this is connected. the event equipment we have imported. We need event equipment for my entire business. Then the fifth one, VAT paid on all common expenses incurred on providing of services of event management, rupees 2,588,000. Again here, it is what? It is VAT paid. It's a common expense incurred on providing of services of event management. Common expenditure. Then VAT paid on repair and insurance expenses of CEO and managing directors motor vehicles, rupees 145,000, which supported with the valid tax invoices. Can we claim this? 145,000. No, we cannot claim. Why? Under section 22, subsection 6, it's very clearly provided, which is the traveling purpose motor vehicles, any expense including repair, insurance, whatever, it shall not be claimable. Even it has supported through the valid tax invoice. Then it's for the sixth one, and the details of the payment of what? January this month, February and March this month. Now, when it comes to this, January, February and March, our quarter is on quarter ended 31st March 2024. Then that's mean January, February, March. If it is so, what is the due date of the payment for that? It's a 20 or no before 20th day of the subsequent month. After ending the 1 month, we are not paying for the quarters, we are paying for monthly payments. Then there is a January month. Then if there is a January payment, is it relevant for our period? January we are paying which one? We are paying on December one. December VAT payment, we have to make the payment on or before the 20th or no before 20th January 2024. That is this one. Then please don't take this. Write it. We have to make the payment. We shall make the payment on or before 20th January 2024 with reference to the month of December. Or the quarter ended 31st December, the final payment. Then I have to take only February and the March, this two. Okay. Then we will do the correction in here, which is this is for first one. I will close this and I need to come for this. Okay. Then correction 2 part 1 TPPL VAT computation for the quarter ended 31st March 2024. When it comes to this, it's up to I'm taking the year of assessment starting from 1st April to 31st March. Then in that up to 31st December 2023, rate is 15% and on or after 1st January 2023 onward, it is 18%. This is there. These are the two rates. Then this is I'm applying the 18%. 2 gazette notifications. Therefore, take this as the 15% from 1st October 2022, and for this to change as the 18% by abolishing this 15% rate, it issued on with effective from 1st January 2024. Then come to this, I will come to one by one, which is on the event management income. Corporate customers, it's in the question, it is 15.1 million. Then here 15.1 at the rate of 18%. Then it's the 2,718 rupees 1,000 it has taken. Corporate customers inclusive of VAT inclusive price. Then I need to go for like this. In the question it's given 10,610. Then it shall be divided by 118 and into 100. And I have to apply the 18%. This is that. Okay. And individual customers at VAT inclusive prices, same application, 7,334,000 divided by 118 into 100 and 18% I have to apply. Then this is my total sales in the local part. And I have foreign income which received event management income received from foreign customers, which is rupees 6 million. In here, from Maldives, section 7 application is there, which is, what is a section 7 application? The providing of service to person, which is providing of services to a person outside Sri Lanka to consume or utilize outside Sri Lanka, and income received to foreign currency bank account in Sri Lanka within 6 months from the end of the taxable period in which the invoice relates. Okay. Then this is the explanation on that one. Okay, then it's a 0% under section 7. And for this one, from Singapore project, it is exempted. Why it is exempted? Now we have for schedule part 3, which is services by a person in Sri Lanka to any other person outside Sri Lanka to be consumed or utilized by such other person outside Sri Lanka, for which the payment is made in Sri Lanka rupees. That's the reason we have taken this as the exempted supplies, because in here it has very clearly given company received the Singapore project amounting to rupees 2,250,000 received from the subsidiary company in Sri Lanka, not to the bank account in Sri Lanka, not from the abroad, it's from the subsidiary company in Sri Lanka. Then it is exempted, not the zero rated. Then this two, which is in here, 3,750 plus 2,250 is equal to 6 million. That's how it's taken. And the commission income is excluded from VAT. Why it's excluded from VAT? The reason is it should be a taxable activity conducted in Sri Lanka. VAT is a domestic tax. Then to charge that, it should be, which is its taxable activity shall be conducted in Sri Lanka. Then for this situation, it's international event. Then it's conducted in another country, and we have just done the link of the 2%. Then it is excluded in here. And Lamai, next important thing you have to think, which here, for this commission income, this input VAT, what we have discussed, nothing relevant. No input VAT incurred on this, be the audio or that visual equipment importation or other common expenses, nothing applicable for this one. Okay. Then here, interest income not liable under normal VAT, and consideration on sale of audio visual equipment, again, on what fraction we have to take that, because in the question, it has made for tax inclusive invoice to buyer. Okay. Then this is the consideration in that 18%. This is totally on my supply. Now, this is total on the exempted and excluded. This is on the liable or taxable supply, including zero rated supply. This is my total. And this is on my output VAT. This is on output VAT. This is there. Okay. And which is on import purchase on event equipment 950, and for local purchases on common expenses 2,588, on the repair and maintenance, repair and insurance expenses of motor vehicle, which by CEO and managing director. Then it's 145. This is my total input VAT. From this total input VAT, what I have to do, this entire input VAT I cannot claim. Then I need to identify directly disallowable input VAT and commonly attributable disallowable input VAT. Now, when it comes to this 145, very clearly, it's directly disallowable input VAT. Then, directly disallowable on repair and maintenance, and the insurance of the managing director and the CEO's motor vehicle, it shall be disallowed. Now on when it comes to these, I need to come for a job, which is explanation in the notes. No input VAT incurred on disposal of equipment and commission income received. The disposal of equipment, no input VAT. And again, for commission income, no input VAT. Then, when taking this base to disallow common input VAT, the revenue base, you have to be so careful. And let me come to this, which is on the application of the disallowable common input VAT. Now, I have the total input VAT. This, from this already I have deducted 145. Then I have only 3,538. This is that 3,538 for me to go for this adjustment. For this, how to take? It's 3,538. I have to divide by the total turnover. I will come to this and I will do the adjustment here. This 3,538, it shall be divided by, this is my total turnover. I couldn't take this from the total turnover, which is here. Or else it's easy for me to take this one. It's a commission and consideration, both are there. I will take this from this one. I need to deduct the commission income one and this plus this one. Consideration on sale of audio visual. This thing I need to minus and should be multiplied by 2,250,000, which is on the exempted supplies. Then it's 157. Let me take this one here. That's the formula, I think. Okay. Then, yeah. Let me do this again. Or else I will take it separately, which is total supply is 43,392. From this, I need to deduct the consideration here. And again, I need to deduct the international event, that income excluded supply 2.5. which is no input VAT allocated to there. Then here we go 36.4. Then I need to take which is the balance input VAT divided by 36.4 million and it's multiplied by exempted supply. Now it's good. And it's multiplied by exempted supplies, which is the 2,250,000. Okay, it's 290. Okay, then that is on the exempted supplies. Which application? Why we have taken this 4,492? It's a disposal of the which audiovisual equipment. Then due to that disposal, no input was attributed here, no information given, we have put the assumption. And when it comes to this commission income, as the which is international event, for that event, we have not incurred any input VAT. Then this is my total turnover. From this total turnover, input VAT is only attributable to other than these two. That's why this calculation we have done here and taken the turnover other than this adjustments, and this is my input VAT after directly disallowable input VAT considered. Then from this, I need to divide the relevant turnover or supply on this and multiply by this exempted sub. That's how it has taken. I think it's clear. It's the computation done. And allowable input VAT. Now I have my allowable input VAT. Then this, I need to go for an export SVAT or zero rate, the section 22.7. In our case, no SVAT supplies, no section 22.7, but we have exports. Then in that, let me take here, this is my total allowable input VAT. It shall be divided by, then let me do this computation. It's easy for you all. Then here, this is my allowable input VAT. From the allowable input VAT, then I need to take, this is my total supply. From this total supply, I need to minus this one, which is the cap, and here is allowable input VAT on the zero rated supplies, and it should be multiplied by the zero rated supply, which is 3,750, 364. That's how the answer came. And after that, on not belonging to above, then the balance from this two. Okay. Then this is the 3,319,000, how it came, and the 100% of output VAT O, which is from balance from above, whichever is lower, output VAT 8,280, balance from here, it is 2,955. Obviously, lower one is this. Then we have taken this one, and the VAT payable is this. From the VAT payable, we need to go for the tax credits, which is 350 and 410 only, this last two. Then I'm ended up with a balance VAT payable in a 2,201,000, which is the no input VAT incurred on disposal of equipment and the commission income received. And January VAT payment is not applicable to quarter ended 31st March 2024. Those basic assumptions I have put. Then here, the identification of the commonly attributable input VAT and this division, all these things are very, very important. Okay. Then this is on the question 2, part A. Any questions on this one? The application of the normal VAT in the computation, different perspectives are there. No questions. Don't sleep. Huh? Then the no questions on this. Then I can move to this 2 5 marks question. For this one, we will go for kind of the analysis and answer format. The newly appointed tax executive of TPPL has highlighted in a monthly management meeting about the importance of the collecting money from the foreign debtors within the credit period of 3 months. They have the credit period of 3 months, and he emphasized that if there is the limitations of the collection period by expiring 6 months from the date of the invoice, it will be directly impact to the VAT return filed and on claiming of input VAT. However, the board of directors of the company has not clear about the statement of tax executive. You are the tax consultant of the TPPL and evaluate the validity of the above statement made by the tax accountant, which is here, and advise the board of directors of the company as per the provisions of the VAT Act. Now the question is, evaluate the validity of the above statement. What is this statement? The tax accountant or tax executive, he has given the statement which is the collecting of money from the foreign debtors are important. Why? Our credit period is 3 months. Then at least by 6 months we have to collect those revenue. And he has mentioned it's impacted on the VAT return filed. Yes or not? Yes. And on claiming of input VAT. What is this provision? Then the evaluation, what we have to do in here, which is in part 1 in that D, then what it has mentioned, the evaluation of the tax executive's state. Now evaluation whether it's correct or wrong. Lama, it's correct. It's correct. Why it's correct? The reason is if we have not collected. Now, as per section 7, which is on this, the amounts to be the foreign currency in amounts to be collected. It to without impact to the input VAT to collect, it should be received within 6 months from the date of the tax invoice, which is a zero rated, that invoice from the date of the export invoice, then within end of the taxable period, within 6 months, it should be received. Now the question is this tax executive, he has mentioned that the credit period is 3 months, at least by 6 months, we have to collect it. Yes, it's correct. He has mentioned that not only that, if not, the return filing is in the question. Yes. Then as per section 7, which is the provisions of the zero rated supplies, then for this, we shall need to go for provision of zero rated supply. I will stop from this. Provision of the zero rated supply. Then the settlement from foreign debtors shall be received to TPPL within at least within 6 months from the end of the taxable period in which the invoice release. That is that. If not, what's happened? Then if not, even though, if not even, the zero rated supplies, are taxable supplies, which can claim the input VAT, if the payment, if not even the zero rated supplies are taxable supplies, which can claim the input VAT if the payment not received as above, such input VAT shall not be claimable as per section 22(6) subparagraph 6. This is the implication. This thing you have to provide to whom? For the board of directors. That's the asking to explain this to board of directors. The evaluation of the tax executive's statement is correct. This is the reason. Okay. This is the reason on that particular statement, which is it asking on evaluate the validity of the above statement. It's correct. And the advice on board of directors, the company, as per the provisions of the VAT Act, both explain taking section 7 and the section 22(6). But however, which I need to tell again, the export, we will take like this. However, the export which recognized under zero rated shall not be liable under standard rate. Liable under standard rate, even the payment is delayed. Even the payment not received during above period. It's very clearly given in the section 7, above period. Gila siyara 18 tax enne. What is the maximum consequence? We cannot claim the input. Okay. This is on that part 1B explanation, which is on the tax accountants view. The provision which you really know, but in the application, these points should be in your answer. And the next one, which is on the 20 marks done, then part 2. What is the part 2? It has asked for the 5 marks, advice. Again, you have to advise the management of SOPL, a different company, on the possible options to minimize tax liability. On the possible options to minimize tax liability for the future periods under provisions of the Inland Revenue Act and its amendments and the provisions of the VAT Act and its amendment while expanding the business through foreign tax. And we don't know anything, but we have to cover our answer as per provisions of the Inland Revenue Act and as per the provisions of the VAT Act. Then come to details given in here. Sky One Private Limited, SOPL, engages in the business of developing various kinds of bespoke software and adoption, upgrading, enhancement, implementation, and similar services related to any software developed by them based on the requirement of the customer. What they are doing, development of software and all these things applicable to IT enabling services. Then due to the quality of the developed software by a team of the engineers, not only the local clients, the foreign clients also demanding the service from the SOPL who makes the payment through foreign currency to the bank accounts. Now, no issue. We are providing not only for the local customers, again for the foreign clients, which is they are highly appreciated us, and who makes the payments through foreign currency to the bank account. Then in our bank account, they are putting foreign currency, and we can go for in the VAT kind, we can go for the zero rated supply. And in the income tax, what's the implication? Please remember. And the following information relevant for the financial year ended 31st March 2024. Then local income from development of software, 78 million. Local income from adoption, upgrading, enhancement of the software. And foreign income from development of software, 25 million. Now you can see it's the lesser amount of the revenue is from the foreign income. And this is for the financial year ending 31st March 2024. And the assessable income from business for the year of assessment 23-24 is 36,250,000. Advise the management of SOPL on the possible option to minimize tax liability or the for the future period under provisions of the Inland Revenue Act and the VAT Act. Lamai, this is what first you have to identify. This is on the information technology enabling services. What has happened? Now let me come to one by one, okay? We need to apply the exemptions in the Inland Revenue Act, including the zero rated supply application, and including if we need to look at even for that, can we go for exemptions or exclusions? Then here in the part B of the question 2. Part B of the question 2, then here. In this, what has happened? Now the industry is information technology. Industry is information technology. What is the implication on the information technology? What has happened? Now, in the income tax, I will take one by one. First one with reference to income tax, which up to 31st March 2023, it is exempted from income tax. Exempted from income tax. And next one, in secondly, which is on from the year of assessment, I will write here, from the year of assessment 23-24 onwards, liable for income tax. Liable for income tax at the rate of 30%. These points you have to highlight. Then the second one, when it comes to VAT up to 31st December 2023, this is exempted from VAT. Exempted from VAT. However, from 1st January 2024 onwards, liable for VAT. This is the current position. With this current position, you have to give a decision. Now, a company which has not paid the VAT, which has not paid the income tax, Then now they are liable to pay. Now take the turnover limit. It's for year, it's 145 million. What is the liable threshold? It's a 15 million per taxable period of 1 month or 3 months, or the 60 million per annum. Then it's exceeded. Then what they have to do? The one thing is, you can see it's asking in the requirement, advise the management of SOPL in the possible option to minimize tax liability. It's asking on tax planning for the future periods and the provisions of the Inland Revenue Act and the VAT while expanding the business to foreign clients. Now we can minimize if we can go for foreign markets. Then here, if I can, now it's a 25 million. If we can go for more than that, more revenue from the foreign income on development of software, what is the implication? Come to this, the option increase the supplies or increase the provision of service, service to foreign clients. This is option 1. Foreign clients, if it is so, what's the implication of the income tax? Any exemption we have on the IT industry? Not on IT industry, but in the commonly under 3rd schedule para U, it's very clearly given in common exemption, which is the service provided to person outside Sri Lanka and utilized outside Sri Lanka if received in foreign currency, it is exempted. Income tax, which is the minimizing of the tax liability, the application of exemption. What is the exemption? It is as per 3rd schedule para U, then services provides to person outside Sri Lanka, and utilize outside Sri Lanka, comma, if income received in foreign currency exempted from income tax. Then for them to take that exemption further, then they can increase the foreign, they will need in the question it has given, which is expanding the business to foreign clients. That's the one option. And in the income tax lamai, the minimization, the second option, then they can go for the foreign business operation. Second one is the foreign business operation. If they have gone for foreign business operation, again, as per 3rd schedule para U, 3rd schedule para U, other than service income mentioned in above, which is other than the service income mentioned in above, then it is received in foreign currency. It is exempted. Okay. This is the tax minimizing options which we have while expanding my business to the overseas. Okay. This is the earlier position and current position. The increase, how to increase the, which is how to decrease the tax burden while going for the exemptions. This is on the income tax. And when it comes to VAT, when it comes to value added tax, it's the services to foreign clients, increase in services to foreign clients, then subject to that conditions of the 6 month and all, it is 0 rated. It is 0 rated. And on the other hand, for the foreign business operation, foreign business operation, it's totally outside Sri Lanka. This is not liable for VAT. Not liable for VAT. Okay, these are the two options. One is from the charging section of the VAT. Other one is the application of the section 7 in 0 rated, and the third schedule and the third schedule para U application. This is the current provision. And here, these are the advices which we can give as per the provisions of the VAT Act and the Inland Revenue Act for them to minimize their tax liability. Okay, go for more exemptions. With this is the end of the question 2 of the paper. Then with this entire first 50 marks completed. Any questions? It seems to be no questions. I guess that you'll not sleep. Then seems to be no questions. Then I'm straight away go for the section 2, question 3 for the next 50 marks. Okay. Then here for that, let me stop share for a while. Let me share it again because the question, the company taxation question, for 30 marks, we will do this quickly, which is in the paper, the pre-seen with reference to the December 2023 examination. This is that common pre-seen for December 2023 exam. Then here, it's the I will give the overview quickly. It's a Sunshine Construction PLC. Okay, the construction company, the main construction contractor. Then it's a PLC, and there are two companies, not only this one, there are two companies in subsidiary companies of these two, which is, if I have came here, this is Sunshine Construction PLC, which our company, and these are the financial information of the company. I'm taking this financial information when we are doing the question, and the income statement details, and which I need to come. There is a manufacturing company, and there is another company. The three companies are there within the group. This Sunshine Manufacturing Private Limited, SML, and the which is Sunshine Real Estate and Residency Private Limited, SRERL. These are the two companies which we have other than our main company. Okay. Then the basic information of this we have to apply to our question. Now, what's the question asked? It's okay. Then which is should we apportion input VAT on equipment? Yes, it's asking on the VAT question. The input VAT on equipment, it is the equipment for an entire the business. Then that's why I have explained that the equipment is for the entire business, not for a one part. Then whatever the we are doing the event management activities for on the corporate customers, individuals, exclusive, inclusive, for anything, then it is applicable. It's a commonly applicable. It's not that for one thing we need to take. It's a common the equipment. And next one, which is only services provided to outside Sri Lanka is exempted. Yes. If goods are supplies, will the exemption be applicable? No, not at all. If the goods, if we have done, it's export of goods. What's the income tax rate? It is 30%. The corporate income tax rate is there. The exemption is given only for the services provided. Under that room of the services provided, for even IT sector, even the whole exemption has removed, then we can take the exemption under commonly applicable exemption on the service sector. If it is goods, it is considering the export of goods, then it is under gains and profit from the export, it's a 30%. It is liable, particularly on services. Commonly, this exemption has provided, and the foreign business operations. Okay, then that 10 of 2021, I think that on us about the capital gain payment due date and the return filing due date. Then, okay, I will move to the question, which is in the question I'm taking here. And once it's required only, I'm moving to the pre-scene discussion in the original pre-scene. Then question 3, based on the common pre-scene issued in December 2023 exam, in addition to information provided in the common pre-scene in relation to Sunshine Construction PLC, the following additional information are made available for the year ended 31st March 2024. The detailed unaudited income statement of SCP for the year ended 31st March 2024 is given below. It's the same as the what is in the original pre-scene. It is there. Revenue, cost of sale, gross profit, other income, administrative expenses, other expense, and the finance income and finance cost. And I'm coming to this, the profit before tax, the 429,000. Then in the 429,000, it is my starting figure as the profit before tax. I'm straight away starting the answer, which is in the tax computation. This is that. Then you should have to have the tax computation and the business income, whatever method. This is a preferred method which I'm using, the plus minus, but in practically, we are not using this plus minus. We are using the method of the add and less. But for exam perspective, this plus and minus, it has it used. Then whatever the feasible method to you, it's okay. Whatever the feasible method, time, it's a limiting factor. Therefore, time saving method, whatever you all can use. Your methods you can apply. Then here, and for the investment income, I'm starting from business income, which is profit before tax, 429,000, which exacted from the income statement. It's in rupees millions. Then it's other details is in thousands. Then it is taken 429,000. Then other operating income, we have dividend, profit on sale of fixed assets, fair value gain on investment property, gain from disposal of listed shares, gain from realization of investment asset, rent income, and exchange gain. I'm not doing anything on these areas. I need to go for the relevant information provided. After all, I will come to those. Then this is on other operating income. I'm just reading the question. Among others, the following expenses are recorded under cost of sales, administrative expenses, and other operating expenses. Then here, direct material consumption, salaries and wages, advertising, rent expense, provision for retirement benefit, bad debt written off, provision for doubtful debts, stamp duty, provision for slow-moving stock, inventory, written off, staff welfare, improvement expenses. Then CSR expenses, depreciation, amortization, fines and penalties, legal fees, valuation fee, research and development expenses, amortization of ROUA, foreign traveling expenses. These are the list of the sum expenses given. And interest income from treasury bills under finance income, gross interest income from savings accounts, gross interest income from fixed deposits, total given. And the finance cost, which is on loans, on overdraft, on ROU liability. Then total finance cost given. And you are provided with the following further information. I'm starting from this further information here, okay, which is SCP has received the dividend income of rupees 29 million from its investments in the share market. As per the dividend warrant, an amount of rupees 9 million was declared out of the dividends received. The same application what we have done in individual taxation also, this was there. The dividend received 29 million. I will come to other income. The dividend income, it's rupees 29 million. From that, there is a 9 million declared out of dividend received. What's the first thing you have to do? This is dividend income. Then this is what? Investment income. What is my principal business activity? It's a construction. Then here it is investment income. I have to remove this entire 29 million from my profit before tax. And I need to recognize it as investment income. While recognizing that final withholding payments and exempted dividend income, I need to recognize. Now come to this. Dividend income, it's removed from the profit before tax, and under investment income, then it shall be like in the dividend income, liable dividend income, dividend paid out of profit. It's a final withholding payment subject to that it's deducted. Then it's a 15%, and which is exempt dividend, dividend distributed out of dividend income, it's rupees 9 million. This is on first thing. Okay. It has done, and when it comes to question paper, I need this to be colored. Okay. Then the next adjustment, which is the SCP sold plot of land which hold as the investment asset on 20th June 2023. Sold plot of land which hold as investment asset on 20th June 2023. The capital gain properly computed as per the provisions of the Indian Revenue Act, 12.5 million, and the company made the capital gain tax payment and filed the return on or before due date. Then if you don't need to compute this again, computed and given 12.5 million. Then in here, which is in other income, it has included as the gain from realization of investment asset. For this one, first, I need to remove it from the profit before tax. Then I will remove this from the profit before tax. And after that, I need to recognize under investment income. Then let me come to this one. The gain from realization of investment asset, then it shall be removed from the PBT and recognized under investment income. Done. Then next one, which is here, the third adjustment, the company has disposed the following two assets during the financial year ended 31st March 2024. One is motor car, other one is the machinery. Motor car lamai, what is this? It is the traveling asset used for the traveling purposes. Is this a depreciable asset? No. Is this a capital asset of the business? In the capital asset definition, is that motor car has included? No. Is this the capital asset held part as investment? No. Are we giving capital allowance on motor cars? No. Any repair, insurance, maintenance of anything with relevant to motor car, are we going to allow that deduction from P&L? In accounting terms, yes. When it comes to tax, no. Then this is what? This is out of scope of the act. Then even this fixed asset has sold. The maximum adjustment which we have to do is there is a gain from or a profit from sale of fixed asset. This profit, it has included in my profit before tax. I need to remove it from my profit before tax, which is the profit on sale of fixed asset. Disposal of motor car, not a depreciable assets, then no adjustment required for tax perspective. You can show this here, but it's not taxable. We are taking the gain and we are not paying tax on that. Any tax benefit we have not taken for this one. And even enact to tax this, no provision. Then it's on the motor car, but we have what? We have the the machinery in the question. It's purchased in 2021, cost is there, and the consideration is there. Consideration minus tax written down value. I need to compute the balance in allowance or assessable charge. Then here on the disposal of depreciable asset, which is a machinery. Then consideration is 4.1 million and the cost has given it's rupees 5 million. Then it's purchased in the year of assessment 2021. Then it's the 2021, 21, 22, 22, 23. Up to 22, 23, 3 years capital allowances given. 23, 24 is the year of disposal. Year of disposal, no capital allowances. Year of disposal, no capital allowances. Then here, for the number of years of the machinery for capital allowances, it is 5. 5 divided by 5 and multiplied by number of years of the capital allowance, it is 3. And here, assessable charge is 2.1 million. The consideration minus tax written down value. Then it's 2.1 million, the assessable charge. Then here, the answer is there. Okay. And the next adjustment, which is the rent income represents the gross income from letting of warehouse situated in Kalutara, which was recognized as investment property in the financial statement. In the accounts, it has recognized as an investment property, but let in a warehouse. The monthly rent is rupees 4 million and utilizes by the manufacturing company. It has rented for manufacturing company and they deducted WST and remitted to IRD before the due date for entire 12 months period during the year of assessment. Then properly WST has deducted. Okay? Then for this one, what you have to do, whether this is investment income or business income, first we have to recognize. Then this is my letting of warehouse. This is my property, plant and equipment. And my business is in construction. Then this is a letting of warehouse which I have used, which I have already used for my business. Now I have given for rent. This is a depreciable asset, which we have recognized as investment property. And for tax perspective, this is a depreciable asset. Then the rent income received from that, it's effectively connected to the business. The 4 million into which is 12, then it's a 48 million is there. Entire 48 million is part and parcel of the business income, but the 10% of the withholding tax deducted, it is my tax credit. Then I need to come for the application of the tax credit here, which is rent income. It is effectively connected to the business. And in the tax computation, here, WST on rent, I need to take it. Okay. Then let me come to the questions what you all have asked. Can you explain if an employee has more than one vehicle, what is the tax implication? Then let me answer for that first. If the employee has more than one vehicle, in the non-cash benefits, let me take this. In the non-cash benefits, we have the non-cash benefit, the particular circular. It's in the circulars. Yeah. Then in this one, non-cash benefit in calculating here. Now come to vehicle benefit. Then here in vehicle benefits, then third one, quantification of the value of benefit including travel in transport or related facilities to provide the employer. Now for the value of benefit from the private use partly of any motor vehicle provided by the employer, vehicle, drive and fuel per month 50,000. It's based on the type of the benefit. Then it is vary if the vehicle and the driver given 30, all given 50 like that. Now come to next one, which is in here, the D. I need to come for the paragraph D. Here, the value of benefit shall be quantified as provided under paragraph 3A. 3A can make. 3A is this one. According to 3A, we have to quantify on what? The value of benefit shall be quantified as provided under paragraph 3A above in respect of only one vehicle from the primary employment and or the secondary employment as the case may be. Then E, where an employee is provided the fuel for more than one vehicle, in the paragraph 3C is applied only for one vehicle from the primary employment and no from the secondary employment. Then these are the restrictions it has provided and it's on this is on the actual expenditure if it has incurred. Then under that situation, we need to take the actual benefit which it has reimbursed. Then for this one, what it has very clearly given Lamai, the D and E, the both, the value of benefit shall be qualified for 3A only for one vehicle. Then this non-cash benefit in the vehicle, drive and fuel, this 50,000 is limited to only for one vehicle. Then if the two vehicles provided, the one vehicle is going under this situation and the other vehicle, is it excluded? No. කිසිම තැනක එහෙම එකක් කියලා නැහැ. Then the second vehicle, it is taxable on the actual. Then it is on the whatever the market value which is applicable for that, or else if the reimbursements are there, in that actual basis, it will be applicable. The circular it has given, the amount is specified in this one, it is only applicable for one vehicle. The benefit is given for one vehicle. In the second vehicle, then it is the actual, if there is the benefit is there, then it's in the primary or secondary employment, we have to take that benefit. It's only one vehicle from the primary employment or secondary employment, as the case may be. The value of benefit shall be qualified as provided under 3. Shall be qualified as provided under 3A. ඒකෙන් කියන්නේ අනික් එක exempt කරලා ඒකෙන් කියන්නේ මේ උඩ තියෙන the whatever it has mentioned, at that value you can apply for one vehicle. Then for other vehicle, what is the value? It has not excluded. We need to go for that actual benefit. It's applicable. This is on that question, and from the circular itself, it has explained. And the what is next? Why the motor vehicle disposal gain is not taxed. Then it has explained the motor vehicles, which is, let me come to the paper. Then in the motor vehicle, it is a traveling purpose vehicle. The traveling purpose vehicle, look at the definition of the depreciable asset. In the definition of the depreciable asset, which given in the, very clearly, again given in the 4th schedule, the depreciable asset and the definition of the commercial vehicle, which eligible for capital allowances. Then in that, the under depreciable asset, this traveling purpose motor vehicle not included. Commercial vehicle, traveling purpose motor vehicles, the excluded clearly in that. In the definition of the capital assets, the traveling purpose motor vehicles excluded, nothing. Then therefore, the gain from disposal of motor vehicles, which we are not giving any benefit for tax. We are not claiming capital allowances. None of the deductions we are not giving. Then under that situation, it's out of scope, that particular asset. We are not taxing the gains from the disposal of the traveling purpose motor vehicles. Okay, but in the department, there may be different arguments, but according to the provisions of the Act, it's not taxable, which is in separately, it's out of scope of the, in the types of the assets, which we have to compute the gain. Okay, then that is on the adjustment number 3, 4 done, and the exchange gain comprises following. What are those? Realized gain from settlement of foreign creditors 7 million. Unrealized gain on conversion of foreign currency denominated accounts at closing rate, altogether 10 million. Now where it has included in exchange gain as the other operating income. This 10 million, then out of this, here, from this one, realized gain 7 million on what? On settlement of the foreign creditors. Now, in the exchange gain, we can divide into two components. One is the translation. Due to the translation, what we are receiving, the gains, it is again one kind of the exchange gain. Then it is lamai realized or unrealized? Unrealized. What are the instances? To conversion of the cash and cash equivalents at the end of the year. Conversion of the foreign debtor. Conversion of the creditor. This is due to the accounting standards we are doing at the closing rate at the year end. It may be realizing next year. It's a different story. But in the year end, from the translation, there is a circular issue very clearly explaining instances on the application of the foreign exchange gain losses, which is not much but I will give the which is in a normal explanation. In here, the translation is one, which is unrealized, and transaction, which is exchange gain. On behalf of the transaction, there may be exchange gains or exchange losses. Transaction means due to the settlement of the creditors, due to settlement of the debtors, like that. Maybe the like that, there may be realized business gains. Then any realized business gains, it is part of your business income. It is actually happened. And any realized the exchange losses, it's deductible. And unrealized exchange gains, not taxable. And the unrealized exchange losses shall not be deductible. These four, I think you can remember. Then under that, which is on the realized foreign exchange gain due to the settlement of creditors, rupees 7 million, then it is part and partial of your business income. And the unrealized gain on the conversion of the foreign currency denominated accounts at closing rate, this is not taxable. This should remove from the profit before tax. Then let me come to here. Exchange gain, realized business gain, it's a part of the assessable income. And exchange gain, which is unrealized, shall not be part of the business income. It should be removed. That's on the next adjustment. And with that, in the other income, these things we have done. And the which is on sixth adjustment, the advertising cost of rupees 300,000 incurred for disposal of land and balance part of commercial advertising. Now there was a disposal of land in the adjustment number 2. Then for that disposal, this advertising cost of rupees 300,000 has been incurred. Is that incurred for the production of income of the business? No. It's for a disposal of an investment asset. And the computation correctly done for investment asset, what we have to do, since this has not incurred for the production of business income, we need to disallow this 300,000 in the computation. Advertising expenses, disposal of investment asset, it has disallowed. And in here, which is the advertising expenses, I will color that. And the next one, which is the sixth one, directors' remuneration amounting to rupees 4 million included in salary, and the APIT has not been deducted and remitted on behalf of the such part of the salary. The director, there is the salaries and wages in here. in that salaries and wages, there is a 4 million worth of direct remuneration which the company SCP has not deducted the APIT. Can we deduct this salary or direct remuneration from our when computing business income? No. Why? Under section 10 subsection 2, the relevant withholding taxes or relevant APIT, it has not deducted, then therefore this shall be disallowable. Direct remuneration, relevant APIT has not deducted, then therefore it shall be disallowed under section 10 subsection 2. And next one, which is the, this was a disaster. Then I need to remove this for somewhere else. Okay. Then next one, rent expenses incurred for 2 sites situated at Kotahena and Gampola. In both cases, the last 3 months, WHT has not been deducted by the company. The monthly rent of the one site is rupees 500,000, which was equally distributed within the year. Now there are 2 sites, then to 500,000 for 1 into 2, 1 million. Then for the 12, it's 12 million. Among this 12 million, for last 3 months, WHT has not deducted. Then it's altogether rupees 3 million. The relevant WHT, which is on 10%, it has not deducted by us. We are the withholding agent. We have to deduct 10% withholding tax on that before we are remitting to the rent income for the owner. Then that particular component we have not done, therefore this should be disallowed. Site rent expense, relevant WHT has not been deducted for last 3 months, it shall be disallowed. It's a 500,000 into 2 sites for that multiple by 3 months. That is on the site rent. And let me come to here, mark one by one on the rent expenditure. And next one, which is a corporate custom, the gratuity paid during the year of assessment, 6,740,000, very easy. Payment of gratuity is an allowable, it's a deductible, which is a reduction of the liability. With this, I will take the provision of gratuity. The provision of retirement benefit obligation, 31,235,000, 31,235,000. And the next one, which is here, the corporate customer badly affected by the financial recession has considered under bad debts and decided to write off. However, CSP has not taken adequate recovery actions prior to the bad debts written off, since it was not the long outstanding. Then what has happened? The bad debt written off in the P&L here, bad debt written off 1,120,000. Entire amount shall be disallowed. This entire part shall be disallowed. Why? What's the reason? Reason is we have not obtained any recovery action on this. Then 1,120,000 legal actions were not obtained. Therefore, it shall not be deductible. And next one, which is the consultancy fees paid to Mrs. Amaravansha, senior architect. However, the relevant WHT has not been deducted at the time of payment of consultancy fee. Lama, small issue, the consultancy fee expense is not in here. Then don't worry, I will explain the adjustment. Then the consultancy fee, it has paid to resident individual, Mrs. Amaravansa, and independent service provider, professional service provider, it's a senior architect. What is the application of the WHT? It is if the monthly payment to the independent Professionally, the service provider. If it is monthly payment, if it is exceeds 100,000, what is the applicable WHT? It's a 5%. Then that particular 5% has not deducted, it shall be disallowed. Then anyway, this is disallowed if the amount has provided. Then the next one, which is the 12, stamp duty on stamp duty paid in connection with the purchase of land and building by Mr. Punchi Banda Appuhami in his individual capacity. In this case, present in here, the Punchi Banda Appuhami is the owner, the co-founder of this SCP. Then it's very clearly given from his individual capacity for the purchase of the land, stamp duty paid, totally domestic expense, not incurred for the production of income of the business. Then it is a domestic expense. But however, in this case, it is disallowed due to it being a domestic expense. Now think that this is not the domestic expense incurred with reference to purchase of land for company. Then what's your treatment? Is it again deductible? No. In the section 11, it has mentioned we can deduct expenses if it is incurred for the production of income incurred during the year, but other than capital nature. Then even we have incurred it for our company, it is if it is for a payment for the land, it's a capital need. It should be capitalized for land, then it shall not be deductible. In different scenarios, you have to analyze that. This is just one scenario to consider it as a domestic expenditure. Then 346, it shall be disallowed in stamp duty, which is a domestic expense. Done. And next one, which is the staff welfare includes rupees 1 million, a gift given to head of project manager due to successfully completion of the highway project. However, this has not included in his employment income. Then this is the questions we have to ask a little bit. Who is the head of project manager? The head of project manager is an employee of SCP. What he has received a gift. Its amount 1 million. Now ask the question why he has received the gift. Due to successfully completion of his office work. Then very simply, he has received this 1 million worth of gift is due to his employment income. If I have received in my employment due to my employment income, then I have to pay tax on that. Then what it has mentioned, this has not included in his employment income. Then since this has not included in employment income, the individual employee, head of project manager has not paid the income tax on this. Then company also going to deduct this. In which provision which we cannot do this under section 197. Domestic expenditure. To expense to not to be a domestic expenditure, it shall be included in the employment, the particular person's income. Then in our case, it has not included. Then this 1 million, it should be disallowed when computing. Either party has to pay tax. That's the ultimate thing. Either individual, either company. Then staff welfare, gift given to head of project manager, not included in his employment income. Under section 197, this is domestic expenditure. Then it shall be disallowed. Next one, which is the staff welfare. Let me highlight it. If not, the figures will be missed. Staff welfare. that has. And next one, which is the a plant and machinery which was purchased during the year of assessment 2021 at a cost of rupees 12.2 million is modified during the year by spending rupees 6.2 million. In here, there was a improvement expense rupees 6.2 million on plant and machinery. Then here, what we have to do, we need to look at the disallowable improvement cost. It has purchased in 2021 other than class 4 asset category. Then it's the 20% from the previous year's tax written down value we need to take and compare it that with the actual cost. Let me come to do that, which is the improvement adjustment plant and machinery. My previous year is the year of assessment 22-23. In that, what is the tax written down value? Then it has purchased in the year of assessment 2021, then 2021, 21-22, 22-23. Then this is 3 years. Then for this one, which is the cost is the 12.200 divided by 5 into the 3. This is the cumulative capital allowances claimed, and my cost is 12.2, and this is the tax written down value for the 22-23, which is in the previous year. That's how this has taken the same answer. From this, maximum 20% of the previous year's tax written down value I have to take. This is 20%. Then actual improvement cost charged to income statement is this. Excess or maximum limit, which is disallowable improvement cost, is this minus this. Okay. Then this 5,224,000, it shall be disallowed. The work-in has given to you. Okay. Then the next one, which is the CSR expenses related to donation made to Ministry of Health for the purpose of the purchasing essential medicine worth of rupees 2 million, and the balance is for planting trees near the main road of the selected towns. Then for this one, which is CSR expenses, what's the value here? 4.3 million. Entire 4.3 million when computing the business income, it shall be disallowed. Why? It has not incurred for the production of income. But from the tax computation, as the qualifying payment, we need to take this, the qualifying payment as a donation to Health Ministry, the donation to government, that only that part I need to take. Then the next adjustment, these are very easy adjustments. And the next one, which is the details of the assets acquired during the year of assessment, is as follows. Then the details of the assets acquired, why these details given? For me to compute the capital allowance, compulsory adjustment, which you earn marks, very easy adjustment. Plant and machinery, how many number of years? 5. Site equipment, 5. Computer and accessories, 5. Capital work in progress is not a depreciable assets. Then no capital allowances. Always look at these, which is assets are depreciable assets or not. Then the depreciable asset definition is critical, which is depreciable asset to be, it should be an asset you employ in the production of income of the business. Due to that employment on that assets, due to wear and tear and obsolescence, then the value of the asset going to fall down. Then quickly let me come to computation of the capital allowances, which is in here. Plant and machinery, 5 years. Site equipment, 5 years. Computer and accessories, 5. Capital work in progress, no capital allowances since it's not a depreciable asset. Now next one, which is capital allowances on the opening depreciable assets. Capital allowances claimed during the year of assessment 22-23 was rupees 345 million. None of the assets were fully depreciated for taxation by end of the year of assessment 22-23. Now, this is on the assets acquired during the year, but this is for opening depreciable assets. The previous year, what is the amount of the capital allowances in totally 10? Then when it comes to this one, the 345, in this, what you have to deduct? You have to deduct the capital allowances applicable for disposal. Why? The disposals are done in this year. But this capital allowance computation is for the previous year. Then the year of disposal, we are not giving capital allowances. That capital allowances component also included in that amount. Then not in the motor car never ever eligible for capital allowances. Then for machinery, which is the 5,000 divided by 5, we have to remove from the opening capital allowances. Here we go, which is on the capital allowances on opening depreciable assets. Total capital allowance claim for year of assessment 22-23 for 345,000. Then less capital allowances applicable for disposal on machinery. It's a 5,000 divided by 5. 5,000 divided by 5, then it's 1,000. Then the opening capital allowance applicable for year of assessment 23-24 is this 344,000. Okay. This is on the opening capital allowance. And next one, sorry, which is fines and penalties relate to delayed payment of EPF, ETF contributions to those entities and tax payments to the Department of Inland Revenue. Any penalties or interest which paid to the government, it shall be disallowed. Then penalties and fines, here we go, 3.3 million, entire part, it shall be disallowed. What next? Then legal fees are incurred on legal services obtained for recovery of doubtful debts and the labor tribunal cases incurred for the production of income we can deduct, but again subject to deduction of the withholding tax if this legal fee, it has obtained from the individual person. If it is more than 100,000 years, the 5% WST shall be deducted. Individual when it's a legal firm like a partnership like that, then that's not applicable. That 5% of the withholding tax on service fee, it is totally applicable for the resident individual who are in the independent professional service providers and non-teaching, lecturing, invigilating like that, the commission agent, insurance brokers, then like that. Okay. Then in the legal fee, let me come to that. The legal fees for the incurred for the production of income, and assume that if paid to resident individual, the relevant WST has been deducted. Then thereby no adjustment required for us. And the next, which is foreign traveling expenses, include the visit of the younger son of the Mr. Kamal Veragama, one of the directors, amounting to rupees 2.1. Domestic expenditure, it shall be disallowed, which is the foreign traveling expenses. In that, 2.1 million shall be disallowed. And next, which is R&D expenses were incurred in relation to the research for the manufacturing of asphalt. However, it is still under the development process, and whether successful or not, it's in a question. Now, what is the question? This is under section 15. R&D expense before deduct. What's the first thing you need to look at, Lamai? Application of the section 11, subsection 1. It's very clearly provided that the R&D expenses incurred for the production of income. Now for this one, it has not incurred for the production of income, and we don't know whether it is successful or not. Then entire R&D expense, it shall be disallowed due to that reasons, because it has not incurred for the production of income. Then R&D, research and development expenses, here we go, 3.9, it shall be disallowed. And please remember, in R&D expenses, the additional deduction of 100% additional deduction, it's no more applicable from the year of assessment 23-24 onwards. And next one, which is next one is the total savings deposits. Interest represent the interest income received in foreign currency. Now in the finance income, here the savings interest is there. Interest income from treasury bills and savings account 5.8 million. It's totally receiving in foreign currency. The 5.8 million totally received in foreign currency, then it shall not liable for tax. Now, let me ask a question. The savings interest, is it in part of the investment income or business income? Lama, it is effectively connected to the business. For savings account, we are not going to have interest income. It's on my day-to-day funds. It's coming to current account as well as the savings account. Then therefore, the savings account is not the investment income. It's effectively connected to the business. But in this case, it's totally in the US dollars. Therefore, it is exempt. Interest income from savings interest is the US dollars. Then it is exempted. And next one, which is the total amount of rupees 18.5 million was made as the income tax quarterly installment payment. Is it a total amount for the entire 4 quarters? 18.4 million paid. Then this is what? This is my tax credit. Then in tax computation, here quarterly installment payments 18.5 million. It shall be taken. Okay. Then the next, which is the actual lease rental paid on ROU liability 6.9. It is an allowable deduction. Then here it's allowed to deduct the 6.9 million. And next one, the total borrowing utilized for the production of income of CSP, then that is on the finance cost adjustment. Then I will come to that later. Then one by one, I will take in the income statement to look at whether everything we have taken. Profit before tax taken, dividend income done, profit on sale of figure, fair value gain on investment property, 59.5, the notional entry, fair value gain of the investment property. It's included in my profit before tax, and I need to remove that. And the gain from disposal of listed shares, it is part and parcel of the investment income. First, I had to remove it from business income, 8 million, and I had to recognize it under investment income here, rupees 8 million. Gain from disposal of listed shares is exempted under third schedule para H. And next, all the income, other income we have considered, nothing to do. Direct material consumption, no adjustment, may okkoma kala. Provision for doubtful debts, 15,610. Any provision, it shall be disallowed. Then the provision for doubtful debts, 15,610. And next one, stamp duty done. Provision for slow moving stock, 20,700,000 disallowed. This one. And the stamp duty done, provision for slow moving done, inventory written off, it is an allowable deduction. Staff welfare done, improvement expense done. Then in the inventory written off, it is an allowable deduction. No adjustments to be done on that. Depreciation and amortization, both disallow, both are provisions. Depreciation and amortization. And valuation fee, then it's a based on the nature, no adjustments given. Then in the valuation fee, it's a based on the with the assumption I will put, which is it is incurred for the capital nature. We need a valuation. Then nature of the expense, then it's taken valuation fee assumed as a capital nature, then it is allowed. Then you can put in other way around also. Then amortization of ROU, where the amortization shall be disallowed, the 3.1 million. And the next one, finance income. In the finance income, interest income from treasury bills and gross interest income from fixed deposit, both 22,200 plus 14,000, both shall be removed from the profit before tax, and it is applicable under investment income. The FD gross amount given treasury bill, anyway it's a, anyway treasury bill is a gross amount. Then it's the interest income, fixed deposit and the treasury bill interest. Okay. Then treasury bills, no withholding tax, no WST. Then here from fixed deposits, then it is the 5% withholding tax is there. I'm coming to tax credits. In the WST on FD, in this 5% I have taken. Okay. Then almost all the things, no. The on loans, ROUA liability, the 8 million, we have disallowed it. No, interest cost on ROU liability, we have to disallow it because the renters are allowed to deduct, and we have actual lease renters we have allowed to deduct, and the interest is interest shall be disallowable. And the disallowable finance cost as the last adjustment by taking the loans and the overdraft. For this one, I need to go for the pre-scene information. In the pre-scene, in financial position, segment, okay. Then here, stated capital is given and the retaining earnings given. Revaluation reserve, we are not taking this too. And we have the bank overdraft not there. Current liability, loans and the borrowings are there. And again in the non-current liabilities, there is the loans and borrowings. Okay. Then the lease liability I have not considered because it's assumed to as the ROU liability. Then here the finance cost adjustment. Let me come to this one here, which is in restriction on claiming of the finance cost. The maximum borrowing limit as per the details of the pre-scene is 28,172,000, which is 15 million plus, which is 5.5 billion into 4 times. Then it's a 1, 2, 3. Yeah, it's a 5.5 million. Into 4 times is there. And my actual borrowing as per the given in the pre-scene is this, then my actual borrowing is lower, maximum borrowing is high, and in the correction, it has provided that separate statement by telling the total borrowing utilized for the production of income of the SCP. Then therefore, which is the entire finance cost is allowable to deduct subject to application of the section 18 what we have done. Then with this, all the adjustments to the question it has completed. This is totals, and this is my business income, and this is exempted and final withholding. This is my investment income. Then on this one, there is a 30% capital gain, the 30% tax liability, and the tax credit is there. Then I'm coming to tax computation. Business income is there, investment income is there. Then the total assessable income, and I have 2 million of the qualifying payment, and I'm ended up with my taxable income. In the taxable income, the gain from realization of investment income, 12.5 into 30%, and the same amount, it is part of the tax credit, 3,750,000. And this is the on balance taxable income, 485,745. It's minus the gain 12.5. Then on the balance, which I need to take 30%. Now this is my total tax liability. These are my tax credits, and this is my balance tax payable, which shall be due within within 6 months from the end of the year of assessment, which goes to 30th September 2024. Okay? Which goes to 30th September 2024. This is on the completion of the 30 marks question. Any question? If not, I can move. There is a question. Does that means company can buy and sell? If you are doing buying and selling, even it's a not as a business can bad. If you are doing now, it's a vehicle is one of the in the fixed asset. Then if during the year, if we have purchased one vehicle and sold it within 3 months, and purchased one and sold, it's a business, it's a trade. Then it's definitely liable. This is, we are talking about a traveling purpose motor vehicles used in the business. Then it's a, don't think about only from the perspective of the gain. Why don't you think about we are not giving any benefit for tax? Then no capital allowances, no expense to deduct, then no insurance whatever to deduct. Then at that point, the taxing of the gain, is it reasonable? No. The point is, it's not covering the, in the tax, we are not look at just the justifiability. No. Then here, it's not categorized under the particular types of the assets in the Indian Revenue Act. And very clearly now in the 4th schedule, under definition of the commercial vehicle, the traveling purpose motor vehicles are removed. It's not there. Very clear it has given when claiming the capital allowances. Then none of the provision in that for us to tax this gain. That's the issue. But in the section 36, which is the computation of gains of the assets, in the asset definition, tangible asset is there. Then the question is, I will take the practical scenario also. Question is under that, are we going to tax on this one? But it's still not, we are not applying the tax on the traveling purpose motor vehicle if it has disposed. Okay. Then this is the remedial action to enjoy the gain. No, you cannot do that. If it is, it's coming under trade. On this question, if you don't have any questions, you maybe feel sleep done, but I had to do the balance part in the paper. Then let me move to the next part, next 20 marks. Very easy, 4 questions, not easy. There are things to which you have to think little bit, but we will come to that. Any questions, you are free to ask. Huh? Then in the, I'm not going for detailed answers, but I mentioned and I will explain the points. The 5 marks it has asked, the advice the managing director on the consequences of the transaction as per provisions of the Inland Revenue Act. What is this transaction? The managing director of SCP is in the view of purchase of 2 concrete mix machines. The 2 machines at once at the amount of rupees 1.5 million. Okay. By using excess cash in hand available in the sale. The transaction is about to be completed on 20th February 2024. Advise the Managing Director, Lamai, this section 10, subsection 2A, which introduced in the amended act in the September act number 8, amended in year 2023. Then for this one, which is, it's very clearly mentioned, you cannot do the single or per day or a series of the single transaction if the aggregate amount is 500,000 or more by way of cash. It shall be made on the account pay only check, bank draft, online transfer, credit card, debit card, like that. The prohibition is the cash payment. What's the consequence? It's asking on the consequence. What is the consequence? It is that the asset, if it is purchasing of the asset shall not be considered, that cost shall not be considered as a cost of the asset. What's the implication? You cannot claim the capital allowances for tax because it's not a cost. asset tax purpose we have not purchased the asset. Then for expense, in that expense we cannot deductible with reference to expenses. Then that's for the 5 marks. Then come to the answer. The detailed answer is there. You all can refer it. Then here, which is on the 5 marks, then 9 minutes you can take. Then for this kind of the things, 9 minutes not taken because you have the idea, you have to quickly write with the provisions of that. Even you can use the open book referential material privilege. Then the consequence on purchasing of rupees 1.5 million worth of 2 machineries by using cash in hand. As per section 10 2A, a sum of money amounting to aggregate of rupees 500,000 or more in a day or in respect of a single transaction or in respect of the series of single transaction relating to one event, if not paid by way of account pay check or account pay bank draft, by the use of the credit card, debit card or electronic payment system through a bank account, any deduction shall not be allowed in respect of such payment in calculating the income of that person. The second one, the amount paid shall not be considered as the cost of the asset of the person. What is a single transaction? Means the purchase or procurement of any goods or service on a single invoice, receipt or statement. This is the any good, this is machinery. As such, under above coverage, any payment in aggregate of rupees 500,000 or more in a day if made by cash, such payment shall not be deductible when arriving into business income, or if asset acquired, such cost shall not be considered as a cost of the asset. This is the consequence. Accordingly, since this is single transaction which aggregate amount exceeds rupees 500, the aggregate amount 500 or exceed. The method when Lakshapad Vadi. That's why it's taken exceeds rupees 500,000 per day. The value of 2 concrete mix machines shall not be considered as the cost of an asset. for tax purpose since the payment made by way of cash. Thereby, the capital allowances on the asset shall not be deductible, even both machines are depreciable assets as per the provisions of the Inland Revenue Act. This is for the 5 marks. This is the consequence on that. Okay, there was the question. Let me look at the question. Regarding the rent expense for which the company missed to withhold tax and pay to IRD, can the company later bear the WHT expense, rather disallow the entire rent? It's not the entire rent, the 3 months, yes, Lama. You can do that because under section the 86, it's very clearly mentioned, which is on the responsibilities of the withholding agent and the withholding. In the withholding agent and withholding, non-deductibility of the relevant withholding tax, then the withholding and withholding agent jointly and severally liable. Then if I have not deducted the relevant withholding tax before I'm remitting it to you, you being the withholding, then I can pay that 10% to IRD in my cash and allow the which is the particular expense. Then it's a which is without paying the 30%, we can allow we can pay the 10% for this 3 months into 1 million into 10%, and for this 3 months we can pay it and close it. Okay, then it is the explanation for in business decision making side. In the computation, we cannot put that with the assumption that in the withholding agent is paid this. No. Then steadily we have to apply section 10, subsection 2. But your point, which you asked the question, is correct. Even practically, we are doing that. We advising to client to pay the 10% on the rent or whatever and allow the, which is take the tax reduce option, which is the without paying the 30%, then they can allow that amount only taking the 10% as the advantage, and even subsequently they can claim it from the withholding. Okay. Then this is on the application of the which single transaction and per day. What's the tax consequence? Come to this. However, the depreciation relevant to machineries shall be disallowed because the accounting terms, these are fixed assets, which is in the property, plant and equipment. Then we have to depreciate it, depreciation disallowed, and what is additional tax burden limit? The depreciation, it's disallowed. Anyway, it's we need to add it back. Capital allowance තුන්නත් නැදත් අපි ඒක add back කරන්න එපා. එතන වෙනසක් නැහැ. What is that? We are losing the claiming of the capital allowance, which is the 1.5 million in that divided by 5. Then it's rupees 300,000 we are missing. On this 300,000, what is my tax implication? I have to pay additional tax at the 30%, which is 90,000. This is there. However, the depreciation relevant to machinery shall be disallowed, and there is additional tax burden of rupees 90,000 due to non-claiming of capital allowance if this transaction done by cash. This is the explanation and the calculation. Okay, that is on the part B. And what's the part C? Part C, again for the 5 marks, it has asked on the discuss the view of the accountant as per the provisions of the Inland Revenue Act number 24 of 2017 and the decided case laws if applicable. Now, case law provision applicable, we will look at for 5 marks what it has asked. At the time of the advertising campaign for a new apartment constructed by Sunshine Real Estate and Residency Private Limited, there is the company which is on the construction of apartment. within the group, which is the Sunshine Real Estate Private Limited. Then here, Sunshine Real Estate and Residency Private Limited is a real estate and property development company. Then this is the just overview of the company. Then apartment constructed by Sunshine Real Estate and Residency Private Limited. One of the which is modelers who involved in promotion was injured and her leg was badly impacted. Due to that reason, the company has agreed to pay rupees 500,000. This is a subject matter. As compensation to her, and the payment will be released within the first week of April 2024. Now the decision has taken and the payment is going on the first week of April 2024, probably in the year of assessment 24-25. The accountant has declared that this payment shall be deductible when for tax purposes, and hence there will be no tax burden on this. Now you have to prove this under provisions of the Inland Revenue Act and the case laws applicable, if applicable. Now, Lamai, what is the concept on this before for anything? This is what? This is the deduction of expenses. Then in the deduction of expenses, what is subject matter? Compensation. Compensation paid to whom? A modeler, which came for advertising campaign and leg was injured due to her participation on the advertising, which is on the video or whatever. Then for this one, the expenditure incurred. Now the question, what's the main conditions to be satisfied to expense to deduct? It should be incurred for the production of income. And it should not be capital nature. And it should be incurred during the year. Then this is the year is a 24-25. It doesn't matter. This is asking whether this is deductible or not. And we have to argue with the statement of the who. It's an accountant. Now under this situation, the expense to deduct, it should be incurred for the production of income. Now the question, is this incurred for the production of income? Then it is for an advertising campaign, she participated. Then its advertising is done for the production of income, but inside the advertising campaign, the injuring of the leg, is it directly relevant to my business? So it's remote to my business. It is remotely connected to my business. It is not the expenditure which is incidental to my business. These points you have to mention. Then even this is not the capital nature. This is the incurred in the which is type of expense which in the advertising it's a connected to business, but through that which is the injuring of the leg and paying the compensation, it's not relevant to my production of the business, which is the apartment selling. Then therefore this is remotely connected. And what is the case law which we need to apply? The Strong versus Woodfield, which is in the hotel, the innkeepers, which is the chandelier, has which is fallen down, and one the customer has damage. The damage they have claimed. Then the court it has decided not to claim this because it's not the incidental to the business. These points you have to elaborate from the provisions of the Inland Revenue Act and the provisions of the case law. Again, here the question 3C for 5 marks is 9 minutes. Now quickly I'm coming to this since I have explained it. As per section, subsection 1 of the section 11, which is the main deduction rule of the Inland Revenue Act, in calculating person's income from a business or investment for the year of assessment, expense to the extent that are incurred during the year by person in the production of income from the business or investment shall be deductible. This is directly application of the section 11. Okay, this is the section 11 application, and again under section 11 too, it is shall not be a capital nature expenditure. And accordingly, in order to claim the expense as a deductible expense, it shall not be incurred. It shall be incurred for the purpose of the production of earning of the profit and income, and should be sufficiently. It should be sufficiently connected to the carrying on any business or investment. Any business or investment. Further, it should not be the capital nature. Then, as per the information provided, the compensation of rupees 500,000 is not an expense incidental to the business, but to remotely connected. This word is now very important. Okay. Then it's a remotely connected. In a company which construct the apartments, this kind of expenses incurred occasionally. Harima kalaturakin ahambeng wenada. It's a random situations. Hence, even compensation for damages, not a capital nature expense, shall not be deducted, since not incurred for the production of income is too remote from that. Then the case law is strong versus Woodfield, the points I have mentioned. Then it's relating to the claiming of the damage happened to the customer. Accordingly, as per the provisions of Indian Revenue Act and the case law, the compensation to modeler shall not be deductible when arriving into taxable income from the business, as it is not incurred in the production of income and is too remote to the main business activity, the production of income. As such, the statement of the accountant is incorrect. That's what for the 5 marks you have to write. And next, which is for 6 marks, it asks for 2 things in the record. What we have to look at, evaluate the expansion strategy discussing the following per the provisions of the Inland Revenue Act and the VAT Act and its amendments. Then it's talking about the expansion strategies. Expansion strategy. Then in that, application of income tax rate, tax exemptions that STP could derive from foreign expansion strategy. That's the first thing. Second one, application of value-added tax on foreign business and supply of construction materials to Bangladesh company. We will come to the details. Then, as per information provided in pre-scene, SCP explore new overseas markets such as India, Bangladesh, the Maldives, the Middle East, and the African countries to secure a new projects to bridge the potential shortfall in revenue of the company, and accordingly they have decided to incorporate a new company in Bangladesh. As the extension, the same business activities conducted in Sri Lanka by SCP, then they are going to incorporate a new company in Bangladesh, the foreign business operation. Under the proposed expansion strategy, SCP shall send relevant construction materials to SCP Bangladesh to obtain cost benefit as a startup. Now what they are asking, application of income tax rate, the Bangladesh project, Lama, it is exempted from income tax, which we have discussed in earlier in the part section 1 discussion, which is the foreign business operation received in foreign currency, then remitted to bank. It is exempted if that condition satisfied, and it's a no tax liability, no tax rate. This exemption is applicable on foreign expansion, and application of value-added tax on foreign business, it is excluded. From the charging section, it is excluded. Then for what is the domestic consumption tax, we cannot go for the foreign countries and charge VAT. It's excluded because the taxable activity not conducted in Sri Lanka. And next one, supply of construction materials to Bangladesh company. This is zero rated. Under section 7, it's very clearly given if the main contractor send construction materials, like this scenario, construction materials to foreign, which is business undertaking, which they are doing, foreign construction projects, which we are doing in that other country, then the zero rate can be applicable. But we need to very clearly the support our answer argument, the SCP Bangladesh is the extension of the SCP Sri Lanka. Okay. Then this is for this one, the various points. Let me come to answer. It's for 6 marks. You can take 10.8 minutes. Evaluation of expansion strategy, the application of income tax rate, tax exemptions from foreign expansion strategy. As per third schedule para U, the gains and profits earned or derived by any person from foreign source, where such gains and profits are earned or derived in foreign currency and remitted through the bank to Sri Lanka, it's exempted with effective from 1st January 2020. As such, if SCP commences a foreign business operation in Bangladesh, it is a foreign source, and if gains remitted to Sri Lanka in foreign currency, subject to this condition. එහෙම නැත්නම් 30% applicable, මෙහෙම හම්බුනොත් not applicable. Foreign currency through bank account, such gains are exempted from income tax. Then, being a resident company, world income, local and foreign will be taxed in Sri Lanka. However, for income received from foreign business is exempted and thereby no income tax implication. This is on the answer for that first part, which is income tax implication, and on the application of value-added tax on the foreign business and the supply of construction materials to Bangladesh company. Then here, in the imposition, what shall be chargeable on taxable activity conducted in Sri Lanka, and therefore the foreign business shall not be liable to VAT since it totally conducted outside Sri Lanka, therefore it's out of scope. You know that. And the supply of construction materials to Bangladesh company, which is come to here, any goods supplied by any construction contractor to be utilized on the construction project carried out by such contractor outside Sri Lanka shall be deemed to be goods export by such construction contractor, subject to the 6-month provisions and all. Then as per provided information, then the proposed provided information, the proposed expansion strategy, SCP shall send relevant construction material to SCP Bangladesh to obtain cost benefit. Then it's a zero rated. It's subject to with the proof that it's a main contractor. It's supplying goods to the foreign project conducted by the extension of the main contractor. Then that is on the part the ABCD for the 6 marks, and for the last for 4 marks, which it asks in evaluate the advice of the former accountant. We need to look at what is the advice of the former accountant, discussing the following further provisions of the Inland Revenue Act. Due date of the return submission under section 93. Due date of the return submission is the within 8 months from the end of the year of assessment. Application of the time bar provision. The time bar provision is under section 135. Time bar provision is the 30 months from the date of the return submission. Don't forget that. The time bar provision comes from the date of the return submission, is not from the after 8 months provision. Okay. Then here, let me come to detail. Sunshine Manufacturing Private Limited has not filed the return of income for the year of assessment 22-23. As per the view of former accountant, since they have incurred a business loss of rupees 38 million, there is no requirement to submit the return on or before the due date. Due to having a loss, then the advice is not to file the return. Is it correct? It is incorrect. It is incorrect. Every person who is conducting, who has the registered for income tax and the conducting business or investment, then they have to file the income tax return. It's a compulsory. Now the due date of the return submission, it has mentioned, and the application of time bar provision also explained, but come to the detailed answer, which is in here. The due date of the return submission as per section 93, return of income and capital gain. The income tax return shall be filed within 8 months from the end of the year of assessment. Accordingly, for year of assessment 22-23, the issue has given in the 22-23 year of assessment. In that, the return shall be filed on or before 30th November 2023. Then application of time bar provision as per section 135, which is on amended or additional assessment, it has given. The application for time bar provision is 30 months from the date of the return submission. Or for any other assessment, the date of the assistant commissioner served the notice of the assessment. Now, for our case, still we have not submitted the return. Then, if Sunshine Manufacturing Private Limited file the income tax return even after the due date, the time bar provision of 30 months will be applicable from the date of the return submission. Okay, this is the one. Second one, return file kala natta. If you have not filed the return, what is the most possible assessment you would receive? It is the default assessment. If there is a default assessment, then for default assessment, since you have not filed the return, no time bar provision. But if the default assessment received to us due to non-filing of the return, then from the time bar provision is 30 months from that particular, the default assessment to, that means to finalize the things is 30 months. However, before the submission of the return, if assistant commissioner issued a notice of default, which is in the original assessment, if not, we will take only this thing because it's only asking on this part, no, if the return submission and that, because it's a two, for the amendment to default assessment and everything, it's a too high, but this more than enough for the 4 marks. Then the Sunshine Manufacturing Private Limited, if they have filed the return from the date of the return submission, the 30 months time bar provision is applicable. For the, in that Default assessment, no time bar provision. Advanced assessment, no time bar provision. Amended or additional assessment, the 30 months time bar provision is coming under section 135 with a change to default assessment, with a change to advanced assessment. Then in here, which is the 2 has mentioned, the application of time bar provision is 30 months from the date of the return submission or for the assessment. One other assessment can explain which is it's only looking at the submission of the return. Then I have not taken further discussion on the amendments to the original assessments. Okay. Then with this is the end of the discussion of the question 3 of the mock paper. Okay, all the points. Yeah, all the things it has discussed. The entire paper it has discussed. Then any questions, we can go for the questions. There is a question. What is the recommended time for income tax calculation? The recommended time means only 54 minutes. It's 30 marks. Then it's 30 marks. You are eligible to spend for 1 mark, 1.8 minutes. Then it's a 54 minutes. Only 54 minutes. You have to go for the computation. And the request is therefore explain the section 46. Then let me come to that one, the application of the section 46. Without going for the notes, I will straight away go for the Act section 46, which is the special realization provision in between the associated persons. Then here, let me come to here, transfer of assets to on associate or for no consideration. Now for this one, this is transfer of asset to an associate or for no consideration. එක part එකක් තමයි දරුවෝ, which is a transfer of asset to an associate. Another one is for no consideration. Now, it has given subject to this section and section 44 and 45, which is 45 is on the transfer of, at the point of the transfer of death, and the 44 is on the spouse transfer asset in spouse and former spouse. Then here, where the person realizes an asset by way of transfer of ownership of the asset to an associate of the person or by way of transfer of any other person by way of gift, with the associate or by way of gift. Then what's the first condition? The market value condition is there. The person shall be treated as deriving an amount in respect of the realization equal to the greater of the market value of the asset or the net cost of the asset, which is market value and net cost, whichever is higher. Before the realization, and the person who acquires the ownership shall be treated as the market value or net cost of the asset, whichever is higher. Okay, this is in the common provision in the section 46(1). Now that common provision is given to one by one person. That's the different on this provision. The section 46(1), it has given a common provision. Now second one, it has given if it has done to the individual, what's the consequence? This is a commonly given for what we have to do. It's a where person for anyone. And in here, it's given for section 46(2). It has given for individual, what's the consequence? In that, the individual or charitable organization. And here, again, this is given for the requirements specified in the subsection 2, the help for this one. The section which is on the individuals and charitable institution, the conditions. Then 46(2) and 46(3) linked together, which is for the among that person, individual and charitable. Now I'm not going to take that. But in the 46 subsection 4, now it is important Now it is given to any person type of the asset. අපි අන්න ඕනේ මෙන්න මේ provision එක. This is a provision which we need. This talks about special asset category. This is talking about the assets, the any asset. But the specification in the 46.4 given for each and every asset, what we are going to transfer in between associated person. Then here, where a person realizes an asset being trading, then what are the type of the asset? Trading stock, a depreciable asset, an investment asset or capital asset of the business by way of transfer of ownership to the asset in the associate person. This is totally given for a business. Then in that, what we have to treat, it's one party is acquiring the asset as the net cost immediately before realization, and other party is getting the consideration as a net cost. But for you to apply this net cost concept in the net cost in the business, if it is asset, the most predominant thing which we can take is the accounting written down value of the assets. Not like that in the investment asset which we have taken 30th September 2017 valuation and done. For the business, most of the cases in the fixed asset, like in the depreciable asset, it's a accounting written down value is the net cost. The net cost definition is given in the section 195 but practically net cost is the accounting written down value. I'm talking about the depreciable asset. Just one example given. Then we can apply this net cost basis if the conditions given in the 46.5 satisfied. I'm coming to changes which happened to the at number 10 of 2021. Then in that, what are the conditions to be satisfied at the time of transfer? Then where the person and the associate person shall be president. Okay, the second one, which is the associate of the partnership, I'm not coming to that. Then here, the next one, the person and associates are the resident, and the tax rates applicable to both, it should be equal or lower. One is higher and one is lower, or the equal. Now equal thing is with us. And the next thing, which is there should be a continuity of the underlying of ownership, at least 50% of the asset. This underlying ownership, that situation comes if the holding subsidiary relationship, if it is there more than 50%, at least 50%. Then if this condition satisfied only, we can go with the net cost situation for the transfer of the assets which we have used in business. Where a person realizes an asset being traded in stock, depreciable asset and investment asset or capital asset of the business by transferring the ownership in between these two associated persons. Then therefore, with the two entities, precedent entities, it's a equal tax rates applicable. If the underlying ownership is there, we can go for this, the application of section 46.4 subject to 46.5 conditions. This is a common provision. Then in the common provision, it is more or less applicable for the gift. Then for this one, it's talking about the associate persons, not on the gift. Then if it is transferring between the gift, which is under no consideration situation, 46.1 can be applicable. I think the answer is clear to you. That was the last, not the last question. What is the recommended time QR? Any other question? Oh, wait. Sorry. Okay, then if it is clear, then it's okay. Then, okay. Then any other question is not there. Can we stop? It's 11:19. Then it's, I think it's good time to stop. And no further questions. Yes, there is a question. What is the question? Okay. Yeah, I will share all the answers. Sorry, there was one mistake from me that 30th September 2017 valuation. It was, I don't know how it missed. Anyway, it missed. Then thank you for pointing out that. Anyway, I will send this to Institute and anyway, they will share for sure all the needful things they will do. Then don't worry on that. And for your examination, which I need to tell, the wish all the very best for your examination. And hopefully, please manage your time. Is nothing other than anything is the managing of your time. Then even, but I have mentioned how many times. It's if you have not managed your time, then it is a disaster at your examination. I'm pretty sure all of you all get ready for examining very well. Then it's only thing, take the effort, time till the last minute, last second, don't stop. Okay. Then in the same way, which all the subjects, what we are doing, you have to apply with the concern of the be a chartered accountant in a recent future. Okay. Then which is I wish all the very best for all of you all for your exam and the future success. Then let me wind up the session. Thank you very much for the interactive participation, asking question and the which is clarify the matters and highlight my errors also. Thank you very much. It was really interactive session. Thank you very much for all of you all and good night. I think all the answers I have given. Any questions? Okay. Okay. Then I will wind up the session for sure. No worries. I promise I will share the answers with you all. Thank you very much. Good night.